really care about their customers.
I don't believe it. A financial institution.
They really care about their customers.
I don't believe it. A financial institution that cares about people.
Yes, and they really take the time to get to know me at Gulf Coast Bank.
I'll see pigs fly before I see a bank that cares about customers. Maybe it is time I switched. What's the name of your bank again?
My bank is Gulf Coast Bank and Trust, the bank that cares about you.
Good morning. My name is Paul Richard. I will serve as your program moderator today for this virtual program. I am a commercial realtor with Latter & Bloom and a member of the New Orleans CID, Commercial Investment Division. On behalf of Gulf Coast Bank, our title sponsor, and the boards of CID and NOMAR and its 5,000 plus members, we welcome you to the 10th Annual Economic and Real Estate Forecast Symposium. We would also like to thank our sponsors, the Louisiana Realtors Association, LR, LACDB, and NAI Latter & Bloom, as well as our 2020 CID chapter sponsors, which are listed in the digital program booklet. We have an exciting and informative program today with an extraordinary group of speakers. Our theme for this year's forecast is the New Orleans economy, pivoting to the new normal. Of course, given the global pandemic context of today, that theme is indeed applicable in almost any city in the world today. On tap for today is a deep discussion of the economy and an interesting and perhaps confusing, economic, business, and political dynamic of the real estate market today. We'll look at the real estate cycle, hear from multiple economists and presenters from various sectors that drive our economy today. Today, we'll tackle a number of questions. With COVID-19, has there been a fundamental or perceptual shift in today's market? 2, what does the new normal look like? And 3, what is the short and long-term outlook for the market? By the end of the day, I would hope that you can decide from your own perspective what kind of market we are in today, and at the very least, have a sharper focus on where this market could be heading. Just a few housekeeping notes. Please refer to your digital booklet for speaker bios and a list of our sponsors. If you would like CE credit, throughout the program, you'll be asked a series of questions. It's very important that you answer the question because that will indicate that you're actually on the program. Not answering the questions could jeopardize your CE credit. Of course, this, as you know, this course will count towards 4 hours of real estate continuing ed. Poll questions will be asked at various times throughout the course. To receive credit, you must answer all the questions. You can also ask questions using the Q&A model that you find at the bottom of your screen. You should see the first poll question on the screen now. Simply place the black dot inside one of the circles. You do not need to press enter or submit. If you cannot see the poll questions or having trouble answering, you can let us know in the Q&A tab and our team will help you. Again, you must answer all the questions to receive CE credit. As mandated by the LREC, we will take a 10-minute break per hour. At the beginning of each break, as it has been our tradition, we will present a mix of videos that you may find interesting and informative. We hope you enjoy today's program. Please bear with us, since this is our first virtual program presentation. As always, we're open to suggestions on speakers and topic for next year.
Hello, I am Norman Morris, CEO of the Louisiana Realtors, and we proudly support a variety of events for commercial members and affiliates throughout the state. Louisiana Realtors is your professional trade association established to assist both residential and commercial practitioners. We are the voice of real estate when it comes to political advocacy, professional development, and discounted business services. We also provide management and support services to the Louisiana CCIM chapter and IREM Louisiana chapter. For over 100 years, Louisiana Realtors has been at the forefront of crafting laws and policies to ensure that you, your business, and your interests are fully protected. We are privileged to have aided in passing or defeating several actions for commercial practitioners, including the following: enacting a commercial lien law, protecting the ability for 1031 exchanges to continue to occur, prohibiting transfer taxes on commercial transactions, defeating attempts to lengthen the eviction process in Louisiana. We've assisted in extending the historic tax credits in Louisiana. We've also worked with the Louisiana Real Estate Commission to provide a commercial-geared alternative course for the 4-hour mandatory CE requirement each year. And lastly, we've defeated attempts to place a tax on real estate commissions and on your realtor professional services. I hope you have a better picture of what we do as your trusted partner in commercial real estate. We invite you to utilize our website, larealtors.org, to stay up to date with the latest news in the industry, to be reminded of upcoming events, and to read more about the benefits we offer to our members. We know and value your role as key connectors to the economic growth and development of our communities, and you can count on us to be the advocates for your success. Thank you so very much.
Our first speaker today is Lawrence Young, Chief Economist and Senior VP of Research for the National Association of Realtors. His title of his talk is The Economy of Real Estate, Forecast for America. Lawrence, take it away.
Great, thank you for the introduction. Glad to join virtually. I am in Arlington, Virginia, just right across from Washington, D.C., where our office will be, just a couple of blocks from the U.S. Capitol. We are certainly sharing all the real estate information with key policymakers, including the members of Congress, so they have understanding of the overall, the real estate backdrop, along with how it could help the economy. Certainly, the residential market has surprised us in a positive way in the recent months as the buyers are taking advantage of the record low mortgage rates. But on the opposite side, the commercial real estate facing challenges, especially in the office, hotel, and the retail sectors. The industrials, as everyone knows, online shopping has made it continuing to expand. So we are in a somewhat baffling economic condition. In one sense, things appears to be turning around, certainly on the housing, but on the other, commercial real estate and the other broader sector of the economy still struggling to see where it will go next. So let me try to give you best outlook on what you can anticipate in the upcoming months. First, as related to the economy, the numbers were quite awful. This is the second quarter number, simply off the chart. But as we know, it was not due to somehow the lacking of entrepreneurial spirit or some breakdown in capitalism in America. It was simply due to the government mandate to say the economy had to shut down in order to contain the virus. And I distinctly remember when it occurred because I was looking to watch the March Madness college basketball tournament, but it did not occur. So that is my timeline as to when the shutdown occurred. And in the first few weeks, quite scary conditions. First, on the virus, we really did not know the nature of the virus. What we saw in China was people were dying, ventilators. And then it went to Europe. We saw TV imagery just coming out from Europe. And then it hit the US and we had the lockdown. We were unsure that if we touch a doorknob and accidentally touch our face, is that a death sentence for us? Now with better medical advances, at least we know how to, abiding by social distancing measure, masks appear to prevent the spread. And certainly the number of new cases are rising, but the death rate at least is much lower now compared to back in March. The other scary moment was just on the economy. As realtors, both on the residential and the commercial side, you need that transaction. You need that leasing activity to get your income generation. If you don't have your income, how do you pay your own personal mortgage? So a tremendous amount of concern related to the economic front. So the economy collapsed because of the government mandated shutdown. What I can say is in the third quarter, the number that will come out fresh at the end of this month, in fact, few days before the election, will be very, very positive. In fact, off the chart positive. So we are undergoing this unprecedented economic swing of hugely negative followed by hugely positive. Whether or not the positive number, 30% GDP growth few days before the election will change anyone's mind about their decision, who knows? They say, no, undecided voters are in the less than like 5% of the population, but the numbers that will be coming out at the end of October will be very, very positive. Now, because of the economic collapse, the Federal Reserve went all in, maximum liquidity, lowest possible interest rate on the Fed funds rate, which has driven down the mortgage rates to their historic lows, and also quantitative easing, buying mortgage-backed securities, buying government debt, and also something new, buying corporate bonds, which the US government has never done. So they're going in all in, trying to fix the economy in light of the lockdown. So one beneficial result of this maximum liquidity policy is that 10-year Treasury yields has fallen along with the 30-year fixed rate mortgage, all-time low. Now for commercial real estate borrowing, it should also be falling, but people are saying there's more risk involved in commercial real estate, lending to small business owners, for retail shops. So the interest rates on the commercial real estate loans has not fallen to the degree of 10-year Treasury because the investors are assessing the risk of the commercial real estate, but the residential, due to the government backing of the mortgages, whether FHA mortgages or loans that can be sold to Fannie and Freddie. I mean, ordinary people don't know what Fannie and Freddie is, but when Bank of America, Wells Fargo, Quicken Loan originate those loans, they are originating knowing they can sell it to Fannie and Freddie, and therefore on the residential side at least, the interest rate at an all-time low in terms of mortgage rates. This is showing the stock market return on various commercial REIT sectors. Now, many of the commercial properties are not part of the REIT. They are individual small business owners, so, the small-time investors. But this is very indicative of what is happening in the commercial real estate. Stock market is up from 1 year ago overall, but not every sector. As you can see, lodging is down tremendously, hotel industry suffering. The retail sector naturally is down because especially in downtown areas, as many people are working from home, it is leading to a great decline in revenue in the retail. The commercial financing, office down, along with some residential, more of a non-Fannie Freddie back mortgages where people are sensing there could be a slight risk. But something that's positive, self-storage, industrial, especially warehouses, very positive, infrastructure like building cell towers and the data centers, those are running positive. So broad Dow Jones, along with S&P 500, NASDAQ, they are not too far off from their record highs, but on the commercial real estate stock market return, you see which segment, which sectors are really suffering, while which sector is holding on reasonably well. Let me go into non-economic data of two states that is not Louisiana, Utah and New York. This is a GPS mobility. Everyone has a cell phone. As you walk around, it's tracking the GPS. It doesn't have personal information. It's an aggregate data, so it protects the privacy. So what this shows is that before the lockdown is a reference point of roughly 0. Then we had a lockdown. In New York State, Governor Cuomo decided to say, I will kill this virus. Because remember, they had a huge flare up, many people dying in New York State. So Governor Cuomo took the very strict lockdown and for a longer period. So the red line shows the stricter lockdown period. And while Utah, the governor in Utah was much more relaxing and reopening the economy sooner. So you see more activity, people moving out and about town, while in New York, they're stuck at home. In fact, even today, New York City restaurants are saying they may be permanently out if they cannot reopen in a normal way. Related to the virus, in Utah, they're hitting relatively high number of new cases. As I mentioned, because of medical advances, at least the death rate appears to be much lower in comparison to new cases. While in New York, the number of new cases appear to be reasonably contained. So you can say, well, it looks like New York is working better than Utah in terms of containing the virus, but it's coming at a huge cost. And here is the cost, the unemployment rate. So in Utah, unemployment rate is falling, it's down to 4%. But in New York, unemployment rate is still stuck at 16%. 16% unemployment rate is essentially a Great Depression level unemployment rate. So this is a tough trade-off that many governors across the countries are trying to evaluate. Do they reopen the economy to get the economy going, or do they try to restrict have a shutdown so that they can contain the virus? This is a tough trade-off. So let's see where Louisiana falls into this. So if you look at Louisiana, the unemployment rate of 9.4% is slightly above national average. Note that we are now color-coded because before the pandemic, back in February, all 50 states had very low unemployment rate. In fact, President Trump would have said US economy is running great back in February. All 50 states low unemployment rate. But now you see the divergence. Some states with much higher unemployment rate, like New York, Pennsylvania, California, where they had a strict lockdown. And then you have states that is tourism dependent, like Nevada, Florida, Hawaii, where they have high unemployment rate. But you look at Utah, Idaho, Nebraska, South Dakota, very, very low unemployment rate, because they're pretty much fully reopened in terms of their economy. Georgia was one of the first states, I guess it was the first state to reopen, and you see where Georgia lies in this unemployment rate conditions. Let's look at the total job situation over the past 20 years. So 20 years in the US, the chart looks like the following. The middle of the chart is the subprime-led boom and bust foreclosure crisis, essentially 10 years ago. In hindsight, it's all clear vision. So we know that subprime lending was a mistake. You don't give out home mortgages without income documentation. You don't give out home mortgages that overstretch people's budget. But America did it, and we suffered the consequence of foreclosures. But from the low point of 2010, America experienced the longest economic expansion ever, 10 straight years of job creation. So quite an achievement, 10 straight years of job creation. Then in the month of April, all that jobs gone. So imagine 10 years of job creation gone in a single month. But as you can see in more recent data points, as the economies are reopening, some states a little more relaxed, like Utah, jobs are coming around, but we are only halfway recovered. We lost 20 million jobs in April. We have generated 10 million jobs. We need another 10 million job creation to get us back up to normal. So we are far from normal, but at least you can see we are making progress. Now, some states making faster progress compared to others. Let's look at New Orleans. New Orleans is a very special case in America because you see the job number from year 2000, and then you see a huge plunge downward. That's the Hurricane Katrina. Then you had many people leaving the state permanently, and hence you never recover back up to year 2000 level. But from the low point from Hurricane Katrina, steady job creation. And then right before the pandemic, you are getting very close to hitting the red line, back up to year 2000, then boom, lockdown. So you are back down, and now you are seeing some job creation occurring. But New Orleans is a very unique graph compared to any other major metro city in the US because of the impact of exodus from Hurricane Katrina, but you have been making steady progress right up to the pandemic. Let's look at the income situation. So job market is far from normal, but surprisingly, overall income in the US during the pandemic is actually higher. In fact, rising faster. Normally, people's income would rise only 3 or 4%, but during the pandemic, people's incomes are rising 8, 9, 10%. And you have to scratch your head and say, what the heck is going on? How is it possible for income to rise in a time of high unemployment? And the answer is massive stimulus package. Remember the $1,200 stimulus check? Along with the enhanced unemployment benefit. Someone who lost a job from a department store or say working at a casino, they lost a job. And what do you know? The unemployment check is actually higher than the wages they were receiving. So more than half of Americans had higher unemployment check than the wages they were receiving. Currently, Speaker Nancy Pelosi, President Trump, Mitch McConnell are trying to negotiate the next stimulus package. But one sticking point is Nancy Pelosi believes that people do still need a enhanced unemployment benefit, while President Trump is saying, no, we cannot continue to provide an enhanced unemployment benefit because no one will come back to work. So they're trying to see what the right balance amount is. So people's income has risen, along with many small business owners who took in the PPP loans. If you met various criteria, you don't have to repay that loan. So income has been boosted during this time. What are people doing with income? They're not spending. You cannot go see basketball game. You cannot go see baseball game. Restaurants are not fully open. So people's spending is down from 1 year ago. So you can go to any bank like Wells Fargo, JP Morgan and ask, how is your bank deposit? And they will say it's rising and rising. People are saving up the money, which hints at once the vaccine is discovered, and we know the vaccine will be discovered through American ingenuity, whether later this year, early next year, many drug companies competing, it's a race to who can first discover the vaccine, but many potential promising ones, so it will be discovered. So once it's discovered and widely available, there could be potential unleashing of consumer spending back into the economy because people have accumulated income, they have not fully spent. So once the vaccine is discovered, consumer spending can really take higher once after the vaccine. Let's see where people are spending during this pandemic. Online shopping, no surprise, it is up 25% from 1 year ago. Beer and wine liquor stores. Are people trying to drown out their sorrows during the pandemic? And answer is, well, they cannot go to bars. So he's actually drinking at home rather than drinking at bars. People are bored at home. So they're buying bicycles, hobbies, maybe video games. And also people are stuck at home. So they're spending more money for home, building materials, gardening. But they're not driving as much. They're not spending at a restaurant, and especially New Orleans, where NAR, National Association of Realtors, we had our convention scheduled for this November in New Orleans, about 20,000 people coming. But of course, that is canceled and we are going virtual. So it's going to hurt New Orleans in terms of the convention businesses that would not take place. Clothes, people are not meeting people in person as much. So why do you need new clothes to impress people? So you see where people are spending and where they are not spending at the moment. What about paying for apartments? Are people paying apartments? There are some social activists, sometimes very loud, to say cancel rent, and telling the tenants don't pay rent. So what are Americans doing? Back in 2019, when the economy was doing very well, roughly 90% of the people paid rents on time. During the mental pandemic, the payment ratio is 88%. And apartment owners will say they are quite pleased, quite surprised that rent payment is holding on. So why are people paying rents? Well, remember the stimulus checks and also the enhanced unemployment benefit. So Americans, for the most part, are saying, look, I signed a contract, I have a financial obligation, and I'm going to fulfill my financial obligation. I'm not going to take a hit on the credit score by not paying rent. So right now, most Americans are paying rents on time with no significant damage on the rental payment. But the commercial transaction volume is down tremendously. So the blue line represent large properties, $2.5 million property and over, according to Real Capital Analytics. It is down 68% from 1 year ago in terms of transaction volumes. We took survey of Realtor members, and Realtor members are saying transaction volumes are down, but not significantly as the large properties currently. As to commercial real estate prices, this is a lagging indicator. As of the second quarter, it's still holding on. I anticipate property prices would be falling, much more so in, say, hotel or retail sectors. So it will be falling, but so far, the latest data as of the second quarter is still holding on. But I want to illustrate this to show that over the past 10 years, commercial real estate prices have essentially doubled. So if there is a price decline of, say, 10%, which I anticipate, I think from the overall LTV ratio, the overall commercial properties are in much better shape today compared to back in 2007 when the prices declined at that time. So there will be some price declines, but from overall loan performance, I think it can absorb some of the property price declines. Let's go to the good news on the residential housing sector. Home sales in August of this year is actually better than August of last year. Many realtors would have said August of last year was a very good condition, and this year we are doing better by 10%. So quite amazing. So we went decline during the lockdown and now coming back up, but strongly up. New home sales. This is newly constructed home builder construction. It is up 44% from 1 year ago. So tremendous. Builders build it, buyers are there. So newly constructed home sales up 44%. Some opportunity for land development, maybe purchase land, develop into lot, sell it to the builders, because right now strong demand for newly constructed homes. Pending contracts up 20% from 1 year ago, which is implying that this autumn would be one of the best autumn home sales ever, because pending contracts, leading indicator for closing, up very solidly. What do realtors say to their clients to demonstrate seriousness? They say, get a mortgage approval. And what are consumers doing? They are applying for mortgages. The data that you see here is not refinances. I excluded refinance. I hope many of you were able to refinance and saving some money, but this is only for home buying, and it is consistently up 20 or 30% higher from 1 year before, depending upon which week we are measuring, which means that there are plenty of potential buyers in the pipeline ready to hit the market. This winter will be one of the best winter home sales year ever. So pending contracts is saying best autumn months. Mortgage application is saying one of the best winter months ever in terms of home buying process. Home ownership rate consequently is rising. It is happening across all demographic groups. Very good news. African American home ownership rate is rising. Asian American home ownership rate rising. Hispanic, white Americans, all rising. Very good news. But take it with a grain of salt on the latest data point. It is not spiking upwards. We have never seen a data that spikes upward like that. And this is data from the census because they changed their methodology. Usually, census would randomly select a neighborhood and they would knock on the door to say, are you a homeowner or a renter? And if they see an apartment complex, they'll assume everyone is a renter. So that's how they will compute home ownership rate, but not the latest data point. They changed the methodology. Because of COVID, they made phone calls. And based on the phone calls, they're getting the following result, which is definitely not true, but at least it's indication of some increases. I know for sure home ownership rate is rising, but I doubt that it's spiking up this much, which also raises the question, all this polling, Trump, Biden, telephone calls, there could be some bias in that part. I know the statisticians always say, they are doing everything possible to reduce any potential bias, but at least related to home ownership rate is clearly showing some mismeasurement related to home ownership rate. One constraining factor for home sales is lack of inventory. We just need more homes to be built. So this is a rare opportunity for commercial members to think about lot development, purchasing land, develop. One of the things that we are fighting hard in Washington is to assure that 1031 exchange is readily available. We need to turn those raw land, people sell it, they make a profit, and maybe they want to purchase another land. So, to assure that process of getting more developable land to come onto the market so we can build more inventory, because we need more inventory. Multiple offers has become quite prevalent in especially starter home, mid-price home, and that's a large headache because if there is a multiple offers, by definition, there's only one winner. There are multiple losers, and the losers have to start the process all over again. So that is, quite taxing for people to undergo. Are we going to have any inventory relief later in the year? And the answer is no, because home building, as represented by this housing start, need to be way above orange line. Orange line is the historical average. During the subprime days, we overbuilt. So we had a price decline because of overproduction. Then we had a crash, but the builders have been underproducing for 10 straight years. And the cumulative impact of underproduction is we simply don't have enough inventory. During the lockdown, many governors said to the construction workers, go home and stay in shelter. Now that the economy is open, builders are now getting the building activity done, but it's not a one-day process. It's a several-month process to bring homes onto the market. So no relief on inventory for the remainder of the year. Only in 2021, we may get some semblance of a balanced market condition. New trend because of the pandemic. One is people are preferring buying home in the suburbs, also rural areas or smaller towns, and away from urban centers. Why is this happening? Well, first, people don't want to share elevators like multifamily housing during the pandemic. Another reason is something that realtors constantly tell me is that their clients decide to buy in the suburbs because they feel uncomfortable about some of the social unrest. By the way, all Americans should be treated with human dignity. All Americans, Black Americans, all Americans. So this raising of the issue is, we need to really consider about what is right in America. All Americans should be treated with human dignity. But some of the social unrest had turned violent, rioting, looting, And people don't like that. And they are saying, no, I'm going to go out into what I consider to be much safer areas. I know it's occurring in only a few cities, but some people are concerned whether it could occur in their cities. So some people are making that decision. But I would say the predominant reason as to why people are going to the suburbs is work from home phenomena. I'm currently working from home because DC mayor said, no, don't come to Washington if you don't have to. So working from home means I don't have to worry about commute. In fact, many technology companies believe we are in a completely new economy. Twitter has announced to their employees, you can work from home forever. Then why live in San Francisco where you could have small property very expensive? Why not go into other cities where you can buy a mansion at more affordable prices? Maybe it's not total work from home. Maybe it's some hybrid. Work from home 3 days a week, 2 days come to office. So even if that's the case, why live so close to the city center when one can live further out and not worry about commute? So I think we are in a completely new economy where people are preferring out in the suburbs, smaller towns. You can even consider, people say living in Dallas home prices have risen so much, or even Houston. And some people may say, well, in New Orleans, there's more fun out in New Orleans. So if they don't have to commute so frequently, you may even see people actually changing cities and depending upon what kind of work schedule they have. I think Microsoft is now asking their employees who would like to work from home forever. Facebook believe half of their employees could possibly work from home forever. So we could be possibly in this new economy. By the way, if we had this pandemic 5 years ago, it would have crushed America economically. We didn't have broadband ready. But this year in 2020, broadband was widely available, and hence the Zoom technology, like what we are doing right now, we can do. Another thing to consider is we are lobbying hard in Washington to say, let's make broadband more widely available in rural communities. So we want to ensure that rural communities also have access to broadband. So the market forecast is related to the housing sector, very bright. Home prices rising because of housing shortage. Home sales, incredibly, even though spring buying season was, we missed the spring buying season, the second half is so strong that 2020 could be a neutral year, meaning it matches what happened in 2019. Then 2021, home builders will bring more supplies, the price increases will be tamer, but home sales will be rising. First, we have more inventory, but also work from home phenomena. Even someone who used to be very happy with their home, 3-bedroom home, now say, no, this home is insufficient. I need that 4th bedroom, 5th bedroom to turn it into office space for myself and my spouse. So you will get this additional second order housing demand beginning to build up in 2021. As related to the commercial real estate and the economy, the GDP, even after those huge negative swing and huge positive swing for 2020, it will be overall negative -6%, translating into 4 million net job losses, which means that we will continue to create jobs for the remainder of the year, but not fully recover. Interest rates will be low. Commercial real estate prices on a diversified portfolio will be down about 10%. Going into 2021, I think commercial real estate prices will continue on the retail sector, but then economy turns positive in 2021. So thank you for listening, and thank you for giving me some time to share my thoughts. Now I am going to turn it back to Brent.
Okay, Lawrence, a couple quick questions, and I'd like to remind the audience that if they have questions, please use your Q&A button. It's clear that the Federal Reserve's strategy of maximum liquidity is affecting the market. What happens to the market if the lockdown is lifted?
Currently, like Utah and Georgia, they're pretty much lifted. I think even indoor dining is permissible. I don't know the unique situation in New Orleans or say the Louisiana state, but there is some discussion about reintroducing lockdown because now there's people are saying there could be a second wave. And if there is a second lockdown, I mean, it's just devastating. So first, It is demoralizing especially for business owners to be locked down again the second time. And I'm not sure if the U.S. can continue to print money, because when I said maximum Federal Reserve liquidity, this is just printed money. I mean, they're printing money to provide unemployment check. They're printing money indirectly. I mean, it's the Treasury who is sending the unemployment check, but where is the Treasury getting the money? By issuing government bond. But who is purchasing government bond? It's the Federal Reserve with printed money. So indirectly, right now, all this stimulus measure is printed money. So how long can America keep printing money and still preserve the U.S. dollar status?
How long do you expect interest rates to remain at these levels?
The Federal Reserve, at least their intent, is to keep interest rate at this low level for the next 3 or 4 years. That is their intent. Related to the practicality is that people remember the 1970s. And what people remember the 1970s is inflation was high. So what was the interest rate? Interest rates were also high. So why is the interest rate high when inflation is high? Because if you are a bank lender and you lend out the money, but the money that you get back 5 years later has lost in value. So they are saying, no, only way to make it a business practical sense is that if there's high inflation, I need to charge higher interest rate, knowing that I would have lost some of the value of the dollar. So if somehow printed money leads to surprise in inflation, then interest rate automatically will be rising independent of the Federal Reserve's intent.
Lawrence, we have a question from our audience. Historically, how does a presidential election affect the real estate market?
Historically, so when we look at the past data, it is really a pocketbook issue, meaning that for consumers, they are saying, is the interest rate low? Do I have the income? Is the inventory available? And they purchase based on this decision. They don't care whether it is presidential election year or not. It's a pocketbook issue, except for two segments. One is Washington, D.C., where I am closely. So home sales can swing quickly depending upon presidential election or outcome results. And the other group is the upper end bracket, because they're concerned with what may happen to their taxes depending upon who is elected. And therefore, there's some hesitancy at the very upper end market. I would say right now, this work from home phenomena, we have seen quite a surge of home sales in vacation resort markets, where people are saying, if I can work from home, I can also work from vacation homes. So we have seen that activity, but related to the President Trump, Joe Biden contest, President Trump constantly mentioned he's the real estate guy. We actually had him speak at the NAR convention and talk about how important real estate is to the economy. Joe Biden has said one of his proposals that he wants to introduce is $15,000 home buyer tax credit to help people on the down payment. And that would be very good on the residential real estate. I mean, we need more home building to assure that inventory is there for the buyers. But Joe Biden also mentioned he wants to take away 1031 exchange, which I think would be very harmful for commercial real estate. So we are looking at all the part from NAR's perspective. We don't endorse presidential candidates, we endorse congressional candidates. So whoever wins, we will work with the new administration.
And another question from our audience. What about commercial interest rates and the ability to obtain a commercial loan? How do you see that happening in the next, in 2021?
So commercial real estate loans would generally follow the trend of the 10-year Treasury bond yields. And 10-year Treasury bond yields are at absolute low, 0.7%. So based on that, commercial real estate loans should be about, say about 3%, 3.5%. But right now, it is higher than that. The spread between 10-year and commercial real estate loan is larger. I mean, at least it's not exorbitantly high. So commercial loans, there is some risk assessment that many of the lenders are applying. And unlike residential mortgages that can be sold to Fannie and Freddie, on commercial office loans, retail loans, there is no equivalent of Fannie and Freddie, and that is also hurting the commercial loan availability.
Another question from our audience. How do you feel about the retail commercial marketplace? What do you see happening in that category in 2021?
So retail looks to be difficult because people are doing more online shopping, but the opportunity in retail is the following. People are working from home, which means that people will do more shopping close to their neighborhood, even having a lunch or dinner. So the downtown location would be very difficult, but the suburban location, I think it will hold on reasonably well or even expand. Another opportunity is some of the shopping malls where it's fairly vacant, where some commercial developers can think about how to repurpose, because maybe there is a need for healthcare clinics where it could be in the shopping mall, or say, like the Sears, where, some people are wondering whether Sears will continue to operation or something similar, whether or not that can be turned into a fulfillment centers. So, rather than just overall normal department store, it become like a warehouse, fulfillment centers. Some have hybrid retail and warehouse, so that someone, say, who buys a clothes online, but they still want to walk around, so they go to the shopping mall and pick it up quickly.
What repercussions do you think there would be particularly in the investment property marketplace, if there was an increase in the capital gain taxes or an elimination there?
I mean, it's always negative. Anytime, there is a less incentive, less financial benefit, then there will be lower prices of the underlying assets. So if the capital gains tax rises, there will be fewer transactions, along with the fact that there could be fewer transactions. So, that is always a harmful situation.
As the stimulus money begins to dry up, how do you see that impacted the residential and the commercial real estate marketplace?
So stimulus, it's just a question of whether or not Federal Reserve continue to print money to buy government bond, and hence providing the money to the Treasury to send the money out. So the Federal Reserve is saying they're all in, and they are saying, we're going to be concerned with the federal budget deficit or printing of the money later. Right now, their job is to fix the economy. Now, of course, anytime the government, the Congress and White House, the stimulus measure, if it needs to pass, it has to have the necessary votes. And right now, Nancy Pelosi and President Trump has not agreed on it. So to that degree, the next stimulus check may not be coming along, or next, PPP loan for small business loan, because right now they're trying to do that negotiation. And I think Mitch McConnell said, whatever measure, if they can agree on, they'll probably not be before the election. The money will actually come after the election.
Okay, I think this will probably be our last question. When do you expect Freddie and Fannie multifamily loans returning to higher LTV ratios and not require principal and interest escrowed for a determined amount of time?
That's very specific. I cannot really say, but I will talk with our advocacy team, who always have a good communication with Fannie and Freddie. So we will mention that we are getting questions from out in the field to say that multi-family property, now we have a housing shortage. It's not only on single family homes, but even the apartments, the vacancy rates are running low. I know that because of the eviction moratorium, some of the rental payment, that's a little dicey situation at the moment. But those type of things I'm going to mention to our advocacy team. Maybe they're already aware of it. But in this environment, the last thing we want is housing shortage to persist for longer period, because housing is about not only single family but multifamily as well.
Lawrence, we want to thank you on behalf of CID and NOMAR. We appreciate your presentation and look forward to hearing from you again. Keep up your good work in Washington. And audience, it's now time for another poll question.
Thank you.
Okay, so Is your business predominantly residential, commercial, both, or other? Okay, we're going to leave this up for a few minutes, and now we're going to go to break.
Brent, thank you.
Good morning. Ladder & Bloom is proud to again be a sponsor of the 10th Annual Economic and Real Estate Symposium. I believe the theme of this conference is right on point, pivoting to a new normal. As we all know, there has been nothing normal about 2020. COVID, elections, the collapse of our tourism economy. In fact, 2020 will likely go down as the most disruptive year in our history. Our understanding of normal continues to evolve. The only certain today is uncertainty. And that's why it's important for Ladder & Bloom to sponsor and be part of this informational conference. And who would have thought that during COVID, we have seen the highest sales volume in residential sales in years? Hopefully, the presentations you hear today will add to your personal perspective on what's happening now, and for some, insight into a very uncertain future. New Orleans and its people are resilient. I am confident that as a community, we will adjust and redefine what New Orleans means to each of us. We are so glad to be a part of this event, and here's to a productive 2021. Thank you.
The Louisiana Commercial Database provides a suite of tools for managing and sharing information, making it easier for all parties involved in Louisiana commercial real estate to connect. For sale, sold, and wanted commercial property listings include industrial, office, shopping center, retail commercial, multifamily, vacant land, hospitality, farm and ranch, special purpose, and business opportunities. With the support of the largest commercial brokerage houses in Louisiana, LACDB provides coverage throughout all of Louisiana, East Texas, and the Mississippi Gulf Coast. Since 2001, we've grown to over 1,400 subscribers, representing over 9,000 active commercial listings and 43,000 completed transactions. Join today at lacdb.com.
Hello, Ryan Pierce here, 2020 Board President of CID. On behalf of the board, I'd like to thank all of our sponsors and attendees for joining our 10th Annual Economic and Real Estate Forecast Symposium. For those of you not familiar with CID, we are the Commercial Investment Division of NOMAR. We strive to be the voice of commercial real estate brokerage industry, as well as provide value to our members with relevant CE, networking opportunities, scholarships, and a discounted rate for Louisiana Commercial Database. If you're not a member already, I highly suggest that you join. And thank you again for joining our 2020 Real Estate Forecast Symposium.
Imagine a New Orleans that is the economic heartbeat of the Gulf region. Imagine a New Orleans where culture, equity, and prosperity are what we build and grow.
We get there by making sure that there are jobs that will provide life-sustaining wages. We get there by making sure that there are tools that help our small businesses grow. That's economic development that puts people at the center. New Orleans Business Alliance, culture, equity, prosperity.
Okay, we're back. We'll do a poll question while I'm introducing our next speaker. Our next speaker is Professor Gary Wagner, who is an economist at the University of Louisiana at Lafayette. And his talk will be The Economy of Real Estate, Forecast for New Orleans and South Louisiana. Gary?
Thank you. Certainly, it's nice to be with you this morning. I want to give you a brief update on national economic conditions, tie that into the regional economy, and then give you an outlook for real estate in Louisiana, in particular in South Louisiana. So the couple of topics I want to hit on in particular is what's the national outlook with some regional implications, talking about COVID-19, what it's meant for the state economy, where I think we're heading, the implications are for the real estate market, and then the upside and downside risks at this particular point in time. So let me first start by giving you a little bit of perspective. So this is a chart that's showing you recessions in the United States since 1980. And you can see on the left-hand side, it's telling you how much employment has dropped from the pre-recession peak and how long it takes for the economy to recover. So this is 1981, and you can see that employment nationally fell about 3%. That's where that U bottomed out. And it took about 28 months to gain all these jobs back. If we look at, say, the 1991 recession, nationally we lost just under 2% of our jobs, and it took about 32 months or so to gain those jobs back. If we look at 2001 downturn that we experienced nationally, again, we lost about 2% of our jobs. Notice it took about 48 months, so almost 4 years before we have a recovery. If we look at the quote-unquote Great Recession from 2008, you can see a pretty severe reduction in jobs. So we lost 6% of our jobs nationally, and it took about 6 years to gain all those jobs back. So that was the most severe economic downturn post-World War II by a large margin. And I think why this graph is interesting is it gives you a lot of perspective about what the COVID pandemic has done to the U.S. economy and where we currently are. So that's kind of showing you this orange line here. You can see the very, very steep reduction in employment nationally, where we lost about 15% of our jobs. We're still about 8% below where we were at the beginning of 2020, which means we still have a pretty significant hole to climb out of. But when you hear people talking about a V-shaped recovery in the economy, this is essentially what they're talking about is we had a very, very sharp decline that was associated with the pandemic lockdowns. And then you can see what's at least starting to be a very sharp recovery. So at least at this point in time, the recovery appears to be pretty robust. But obviously, we still have a long way to go job-wise before we get back to where we were in the beginning of this year. And I want to tie that into consumer spending, because I think that's obviously a big piece of the U.S. economy. It drives about 70% of the U.S. economy. And I want to apologize in a little bit in the sense that this is the most complicated graph I'm going to show you. There's a lot going on in here, so I want to just take a quick second and explain this. I think it's a nice visualization for what we're seeing in the housing market and how it differs from what we're seeing in the rest of the economy. So this is looking at components of consumer spending. So if you could just focus your attention all the way over to the left, you see where it says consumption, and you've got 4 bars. So that's growth in consumer spending nationwide over the last 4 quarters. The average growth in the U.S. economy is about 3.3% a quarter. And you can see in the last 2 quarters in particular, which is the first half of 2020, consumer spending overall has been down, and it's been down very sharply. In fact, consumer spending is down about 35% year over year in the second quarter of 2020. You'll notice spending on durable goods, which is the purple bars, gasoline and energy, which is right in the middle of the chart, year over year down almost 60%. Services down, healthcare, which is all the way over to the right, again, down more than 50%. The only area of consumer spending that's sort of bucking this trend is housing. So second from the right, those four, they're dark green bars. You might not be able to see the color very well, but those are actually up just over, spending is up about 2.4%, which is a little bit higher than the historical norm. In a sense, what I'm telling you is what we've been seeing across the board is that consumer spending, we're seeing record contractions in almost every component of consumer spending except housing. It's the one area over the last year that has remained close to its historical average, but it's not significantly stronger than its historical average. The recovery overall is expected to be very strong. So this chart is showing you GDP growth for the U.S. for about the last 10 years and the Survey of Professional Forecasters outlook. So these blue bars are GDP growth for the U.S. economy. The area that's shaded in gray in 2008, so that was the last national recession before the current economic recession. And you can see the worst quarter that we had was in 2009 when GDP growth for the U.S. contracted at an annualized rate about 8%. The second quarter of 2020, we contracted at an annualized rate of 32%, so about 4 times worse than what we saw in 2008. The outlook, however, is very favorable over the next 5 quarters. So I've highlighted those for you in green. The Survey of Professional Forecasters, of which I am a member, is the longest running national forecasting group in the U.S. It's administered by the Federal Reserve Bank of Philadelphia. And you can see in the third quarter of 2020, the outlook is for growth to come in about 19%, slowing down to about 3.6% over the next 5 quarters. To put that number in perspective, from 2008 until 2020, the GDP growth in the U.S. was averaging about 2.2% a quarter. So it looks like over the next year, signs are pointing to a pretty robust recovery. Although I will say the expectation from me is that we're probably not going to see a full recovery of jobs until 2022 at the earliest. For Louisiana and some of the metropolitan areas, which I'll talk about in just a minute, we probably won't see a full recovery of jobs until 2023 at the earliest. Again, the size of the hole that we're coming out of is historic and very significant. But just to give you some other very favorable evidence, so this is a chart looking at what's called core capital goods. So again, I'm getting a little bit technical, but I think there's some positive pieces of information from this. This is new orders, which is shown in blue, and shipments, which are shown in a pink color, looking at year-over-year growth. So this is manufacturing, non-defense related capital goods. And one of the reasons why we look at this is a key economic indicator, and it's a key leading economic indicator telling us where the economy is likely heading, particularly from the orders perspective. And you can see I've shown you this going back to January of 2000. And you've got the 2001 recession, which is that area shaded in gray all the way over to the left. The 2008 recession, which is kind of in the middle of the screen. And you can see year over year orders and shipments declining on the order of 20% or 30% in the last 2 recessions. The recession that started in the United States in February of this year, I've got shaded in gray. You can see a little bit of a dip there, but then a pretty quick recovery. And in fact, these data are through August of 2020. And if you look at new orders are up 0.3% over where they were in August of 2019. And what this tells me is that manufacturers across the country are not expecting at this point a very deep or a very prolonged recession. So this is a very positive sign because this is generally a significant indicator of where the economy is heading. The other reason to be very optimistic is to look at household debt positions. So these are some data from the Board of Governors of the Federal Reserve, and they go back to 1980. This is the longest that we have tracked these data. And the bottom line there is what's called the debt service ratio. So it's the ratio of debt to household income payments, And again, this is across the entire country. This is the only level at which we have the data. The top line is what's called the financial obligations ratio. So it adds in a couple, most debt payments that consumers have. So it's a broader measure of the debt to income ratio. But the reason why I wanted to point this out is all of the recessions going back to 1980 are shaded in this diagram. And I have a couple points that are highlighted. You can see in 2007, just before the last recession, the financial obligations ratio peaked at 18.1. The debt service ratio peaked at 13.2. In other words, both of these debt to income ratios for the United States were at their all-time highs going back to 1980. You'll notice where they are now. The debt service ratio is at 9.7. The financial obligations ratio is at 15.0, which means both of these metrics, these debt to income ratios for households, are either at or very near their all-time low. And what that means is relative to every recession we've had since 1980, households are in the best position financially to weather this economic downturn. So one of the things that happened in 2008 is we had a very severe recession. Households had very, very high debt levels, and it required them to pay down some of their debt balances before they could start buying goods and services again. Households have never been in better shape financially in the US as a whole than they are today. So that's another reason to be optimistic. And I think a third reason to be optimistic is that the interest rate environment is projected to be very favorable for a very long period of time. So 4 times a year, the Federal Reserve issues guidance about where they expect interest rates to be at the end of every year. And you can see that we have colored dots on this chart. And this is a chart that economists simply call a dot plot, so we're not that creative. But if you look at 2020, all those dots are between 0 and 25 basis points. What that tells you is members of the Federal Reserve expect the federal funds target interest rate to be near 0 at the end of 2020. And you can see going out to 2021, 2022, even 2023, the overwhelming majority of members of the Federal Reserve expect interest rates to remain between 0 and 25 basis points for the federal funds rate target. And what this means is that all other interest rates are also likely to remain very low for at least the next 3 to 4 years. So that means the interest rate environment and the mortgage environment is likely to be very favorable from the perspective of buyers, at least for the foreseeable future. Now what I'd like to do is shift a little bit and focus on Louisiana and some of the metro areas in particular. So this is a map of the metropolitan statistical areas within Louisiana. And you can see that kind of 2 MSAs in particular, the New Orleans MSA, which is in red, and the Baton Rouge MSA, which is in brown, those 2 metropolitan areas constitute about 53% of the economic activity in the state. If you look at the 9 metropolitan areas around the state of Louisiana, those 9 MSAs, the parishes that make up those 9 MSAs, account for more than 90% of all the economic activity in the state. And so economists like to look at metropolitan areas in particular because they represent miniature economies in a sense, and miniature labor markets. And so I want to focus a little bit on the economics of these metro areas and what the implications are for the real estate market. So again, looking at the metropolitan statistical areas for the state, we're seeing job losses that tend to be a little bit better than what we've been experiencing nationally. For the most part, you can see the metropolitan statistical areas in the state over the last 3 months for which we have data that are experiencing the sharpest declines are the Lake Charles MSA. And it's important to note that these numbers also do not take into account any job losses that might be associated with Hurricanes Laura or Delta. And you can see the New Orleans MSA, year over year, job growth is down 11%. But if you notice Baton Rouge, which is the second group of bars from the left, so Baton Rouge initially experienced a pretty sharp decline in job losses earlier in the year, but the recovery has been relatively rapid to where year-over-year job losses are down about 5%. So as I mentioned, nationally, job losses are still about 8% below where we were before this recession started. Some of the metro areas in Louisiana are actually faring a little bit better than what we're seeing nationally. I think the one area that gives me some pause, of course, is New Orleans. It's the largest metropolitan area in the state, a key driver of the economy, and we're still seeing job losses in double digits. And I think that's in large part because of the difficulty the region has had in kind of gaining control or gaining some momentum around controlling the COVID-19 virus. But now let me shift gears and talk about home prices and what we're seeing. And I'd like to give you some national perspective as well. So this is year-over-year home price growth using the Federal Housing Finance Agency All Transactions Price Index. So it's a pretty broad price index. Nationally, year-over-year home price growth is around 4%. You can see in Louisiana we're at 3.3%, so we're just below that national average. The strongest growth right now in the U.S. is in the Northwest and also in the Southeast. But I think one thing that's pretty remarkable is you saw the size of the economic hole that we're climbing out of, yet we're seeing the housing market really being a key driver of the growth that we're experiencing all around the country. So home price growth is positive everywhere at this point in time. And a very similar picture when we look at the metro areas for Louisiana. So home price growth is pretty strong considering economic conditions for the region. You can see we've got 3 metropolitan statistical areas in the state that are either at or outpacing the nation. The New Orleans MSA, Hammond MSA, and also the Alexandria MSA. And home price growth, even in the weakest areas, which is in the Lake Charles area before the hurricanes hit, was coming in at a 2.3% annualized clip. But I'm sure you're aware of this. I think it's also useful to point this out. Our real estate markets do fluctuate significantly more than the U.S. So this is showing you year-over-year home price growth for the U.S. going back to January 2010. You can see it has historically been around 5%. We're currently at 4%. I want to add in Louisiana, which is a gold line, and the New Orleans MSA, which is a red line, since that's the largest MSA in the state. And you can see it's just much more volatile. Overall, home price growth in Louisiana tracks the New Orleans MSA very closely, and it has for quite some time. And you can see year over year in New Orleans, we're at a 4% mark. Statewide, we're at a 3% mark. But you do see that volatility in the state that we don't see at the national level. So let me show you quickly here the relationship between inventories and prices, because this is a key piece of what's happening with prices in Louisiana. So this is showing you the relationship between inventory and median home prices across all U.S. MSAs. An MSA is what we call a metropolitan statistical area. It's just a collection of counties or a collection of parishes, making up essentially a regional economy. That's what an MSA is. And what this chart is essentially showing you is that as the relationship, as inventory levels fall, median home prices rise. And in fact, if you look across the entire country, this is a good rule of thumb for you to keep in mind. Every 5% reduction in home inventories leads to median price increase of about 1.5%. And you'll see this is really a key piece of what's happening in the national economy and what's happening in Louisiana, is that inventory levels are really at historic lows. So this is showing you year over year inventory levels for the 9 MSAs or metropolitan statistical areas within Louisiana. Year over year nationally, inventory levels are about 40% below where they were a year ago. You can see in the Alexandria MSA, for example, currently these data are through August of 2020. Inventory levels are 45% below where they were the year before, 37% below in Homa, 35% below in Lafayette, If you go to New Orleans, 36% below where they were. So if you remember that rule of thumb that I'd mentioned, a 5% reduction in inventory leads to about a 1.5% increase in price. You can see this exact relationship when you look at listing prices. So these are median residential home list prices for the metropolitan areas within Louisiana, and you can see in Alexandria, as the inventory levels year over year have declined, listing prices have risen. So in other words, most of what we're seeing nationally and in Louisiana in particular in terms of the home price growth is really being driven by the fact that inventory levels are at these historic lows. And so the key questions kind of moving forward is we've got a couple things on the upside, I think, to point to a strong market is the economic recovery has started out very strong. I think we're likely to see a very favorable interest rate environment for the next 3 to 4 years. Also, household debt to balance, debt to income levels are also very favorable. I think the big downside risk factors, of course, would be COVID-19. And for me, the key is how long can inventory levels remain well below their historical norms. I think over the next 6 months, there's nothing on the horizon that points to inventory levels changing in any significant way. Outside of a 12-month period, when we start to see inventory levels normalizing, you're likely going to see some of that momentum in prices start to soften a little bit. Yeah, sure.
Okay, we have roughly 5 minutes for questions. I want to remind the audience that you have a question, please use your question button on your presentation. Gary, I have a question for you. I was really surprised at the 19.1% increase in the forecast growth for the first quarter of 2021. Why such a large jump?
Yeah, that's a great question. A lot of that large jump is because we experienced such a significant drop in the second quarter. So you see it's just the percentage change year over year. So when you see a very, very large reduction, you're likely to see a very, very large increase.
Okay. The record contraction in consumer spending, should that reverse itself, how would that impact economic growth, not only in Louisiana, but nationally?
It would really do a lot to boost growth because, again, consumer spending is really a key piece of the economy. It's about 70% of what drives U.S. GDP. So when I start to think about what I think is likely to happen to the U.S. economy, I focus really on consumers. And in the early part of 2020, we saw historic reductions in consumer spending. And when we see consumer spending start to tick up, and I think we're likely to see that as well because consumer confidence has actually ticked up in the last couple of months. So when consumers feel more confident and they start spending, we're going to see a significant rebound in growth.
You had mentioned that home price growth was really a function of low inventory. How do the low interest rates factor into that? If inventory decreases and interest rates remain the same, will there be just a similar rate of growth in home sale prices?
It could be. I think you can really see increases in home prices for a couple of reasons. One is you could have just a big uptick in consumer spending and home ownership, which I think the previous speaker mentioned there's some of that. You could also have changes on the supply side, which we're seeing with inventory levels. So right now, the main driver of home price growth that I'm seeing in Louisiana is not that consumer spending is significantly stronger. It's just that inventory levels are so low. I think what's going to help potentially draw more people into the housing market moving forward is that the interest rate climate is going to remain very favorable for a number of years. So you might see new buyers coming into the market, or you may see existing homeowners essentially step up to larger homes.
We had a question from the audience regarding Lafayette. How do you see what's happening in the oil industry impacting the economy of Lafayette currently?
Yeah, it's certainly negative. But one of the things that is worth pointing out is if you go back to 1980 and you look at the Louisiana economy, almost 35% of the statewide economy was oil and gas employment. That number is less than 3% now.
Wow.
If you take areas like Houma and Lafayette, which are still the kind of oil centers in the state, even in Lafayette, only 6% of our jobs are related to oil and gas these days. So what's happened is that industry has matured, and it's still a significant piece of the economy. It's just not the significant driver of the economy that it was, say, 25 years ago.
We had a question from the audience. How does the economic information presented apply to the minority communities, African, Asian, and the Latino community? Do you see any change in the impact in those communities as a result of the economy currently?
So I haven't looked at housing data in particular for those groups that you mentioned. I think one of the things that's very favorable for anybody is just the interest rate environment that's out there. Mortgage rates are near historic lows, which is giving people that perhaps may not have had an opportunity to enter home ownership, they're going to have an opportunity to do that for several years to come.
Question in New Orleans, for the New Orleans area. What would it take to turn New Orleans around, since obviously the job reduction has been severe and impactful in New Orleans? What would it take for the tourism economy? How long would it take for the tourism economy to move those numbers up?
Yeah, I think that's a great question. About 10% of the New Orleans economy is related to travel and tourism, which is the largest in the state by a big piece. And I think that's the one real unknown from my perspective about how long it's going to take the New Orleans region to recover. I traveled a little bit last weekend for the first time, and I was surprised at the mitigation steps a lot of people had taken. And I think once people feel comfortable again traveling, that the New Orleans economy will start to pick up. But that's a question that is difficult to answer because I don't know when people are going to start to feel comfortable again.
Again, another New Orleans question. Why is the New Orleans economy, as well as home sales, why are they so volatile compared to the rest of the state and the nation?
That's a great question, too. The Louisiana economy in particular is very volatile. So if you were to graph growth of the Louisiana economy compared to the U.S., it's mainly due to the industrial mix of activities that we have. So when we talked about oil and gas, that's a very volatile sector. We have petrochemicals in the Baton Rouge region that's very volatile. And then you've got travel and tourism in Louisiana, which is also a very cyclical industry. So it just happens that the nature of the economic activity that takes place in Louisiana is a lot more cyclical than what we see in the nation.
If you had a crystal ball and you could rub it, what do you see happening for Louisiana in the first quarter of 2021?
I think Louisiana's economy is actually growing now. I think we're starting the recovery. I think we are going to probably fully recover late 2022, early 2023. I think we're going to grow at a pace that's slightly lower than the nation. So I would say whatever you see nationally, I would expect us to grow at 75% that pace.
Okay. Audience, I think we've run out of time for questions. Gary, thank you very much. We appreciate the information. That was very insightful. Well, now time for another poll question. So if you would, please answer this poll question. Okay. We have about 4 minutes before our next speaker, so we're going to take a slight break. We'll be back in 4 minutes.
Hello. This is DeWitt Zine David with the NAI Ladder and Bloom Commercial Office in Lafayette with a quick overview of the Lafayette commercial market. As could be expected, with the price of oil hovering around $40 a barrel, our industrial market, which relies heavily on the oil and gas industry, is very soft. Our office market is also soft, and there are some concerns about the future demand for office space since, with COVID, many employers have found that their employees can continue to work at home. As a retail hub for Acadiana, however, our retail market has remained strong, and in fact, the July sales set a new record. Two very bright spots are the fact that we are having more and more high-tech companies coming into our area, and we also have the continued expansion of our medical services. So overall, we look forward to 2021 with cautious optimism.
I'm Clinton Shepard with Latter & Bloom in Lafayette, and my main focus is retail. A lot of what we're seeing this year is shorter term leases. Tenants are becoming a bit more non-committal than they used to be. I believe gone are the days of 10 and 15-year leases. The exception to that rule would be the concepts who have done well through this, the grocery, dollar stores, and auto parts, the pandemic-proof retail, if you will. Another thing we're seeing is more warehouse space to support the traditional locations for retailers. A lot of this was already moving in this direction before the pandemic and before 2020, but this year has definitely accelerated it. Finally, in the restaurant arena, we are seeing that, as you may think, drive-thrus are mandatory at this point, and then also restaurants are moving towards larger patio spaces. So in the future, it'll be interesting to see how landlords charge for the larger patio spaces and how they make up for the smaller dining area.
Hi, I'm Jack Hodges with NAI Latter & Bloom, Alexandria, Louisiana. We're here to tell you a little bit more about what's going on in Alexandria. Recently, we've had a flurry of commercial lots being sold, and we see that office space is being currently leased, but we still have quite a bit of leasing and space available.
Hi, I'm Rod Knowles, CCIM, NAI, Latter & Bloom, Alexandria, Louisiana. Our retail market here, there's not a small or large retail lease that we've not had to renegotiate in the past few days. So it's no big boxes, but a lot of activity on negotiations. Our offices, a lot of government leasing activity, and we're doing a good bit of development with the federal government and the state.
Okay, we're back. Our next speaker is Stephen Waguespack, the President and CEO of the Louisiana Association of Business Industry, better known as LABI. And we asked him to talk about the changing climate of business and politics in Louisiana. So Stephen, take over.
Thank you very much. And, well, I'm glad to be with you all today, virtually, in our 2020 world. That's what we're all used to, so thank you for dialing in. I'm going to talk a little bit about Louisiana politics, policy, what's going on in the current economy, what's happening at the legislature, and kind of where trends may be going. I definitely encourage questions, comments, thoughts towards the end, and so if you have them, I would kind of love to hear your feedback. A little bit about us. I am the CEO of LABI, the Louisiana Association of Business and Industry. Essentially, we're the state chamber of commerce, we're the state manufacturing association. We've got about 2,000 businesses that are members from across Louisiana, and it's every geography, every industry, every region you can think of. And so when we get together in a room, you know, our board of directors is about 100 people usually, and it's every diverse interest you can think of. And I kind of like to say that we're the best thermostat for the business community in the state. I always know kind of where roughly the temperature gauge is for the folks around the state. And so I like to kind of give you that perspective as we go through this. We work with other affiliate partners throughout in Baton Rouge and in DC to help with politics and policy. The Louisiana Realtors Association, Norman and Kim, we work with them a good bit, and they're great partners and allies in that effort. And so real quickly, let's go into kind of what 2020 has been like. And you all know this as well as I am, but you know, 2020, you're going to look back in the history books one day and define what's going on. Yes, there's national election stuff we can talk about down the road if you'd like, but really from a Louisiana perspective, it's COVID-19 impact, not just from the public health perspective, but also the economic impact. And for a state like Louisiana, especially in the New Orleans region, where I know many of you are from, you know, the public health on the front end, but the long-term economic impact will be significant to keep an eye on as we go forward. So if you look at how does this compare to other times, because you know, when you think about Louisiana, there's been a lot of big moments over the years. I grew up in Gonzales, just south of Baton Rouge, and the 1980s were a tough time. In fact, my family and I moved to Missouri during the 80s because, you know, things got so tough during that time period. And if you see on the chart ahead of you, if you look back, what did unemployment look like in those horrible 80s days? And you see about 100,000 unemployment claims, kind of our spike there throughout those couple of years. And if you fast forward to the Katrina and Rita era, you know, during 2005, you see that spiked. We got just over about 200,000 unemployment claims that hit during that time. The Great Recession a few years later that we saw when you had the crash of the oil and gas industry, and you see that spike there. Well, look in this year. The spikes we've seen for this year, obviously off the charts as you can expect, but that continued unemployment claim is still lingering pretty high. In fact, we're just under 200,000 unemployment claims. And many of those, I think, would be continuing, except for the fact that you're limited on filing unemployment for just over 26 weeks in a row. So some of those would still be filing because they still don't have a job. And so what does long, continuous, multi-month unemployment look like from a long-term perspective? And that's what, quite frankly, we're in uncharted waters. We're all trying to figure out what that looks like. When you think of a region like New Orleans especially that's so focused on a certain industry, hospitality, and you not just need to get those folks back open, but also convince people around the country to get on an airplane and travel here and spend time here and eat in our restaurants and hotels, that unemployment piece is difficult. Speaking to Doug Thornton, who runs SMG in the Superdome and the arena the other day, you know, what he's worried about is those unemployment claims when you can't do those concerts. Look, they're trying to do everything they can to keep their employees engaged, because some of those employees might drift into other industries. If you are used to hosting events at a Superdome, next thing you know, you're recruited to go on a road show in another state, all of a sudden your workforce can leave if you're not careful. So we got to get folks back to work soon, not just to help with the unemployment number, not just to help with tax receipts and things like that, but also so our workforce doesn't linger to other regions, states, or even countries in some extent. And that's what we are kind of worried about. In addition to COVID-19 and the impact there, the oil and gas industry. You know, obviously in Louisiana, if it's not hospitality and tourism, it's probably oil and gas that is a big economic driver. And when all of that demand just went through the floor and people stopped traveling, it wasn't just folks going to a festival. Every corporate entity you can think of has dialed back their corporate travel budget, and that's showing up right now in annual and little meetings and visits, but we think it might show up next year in convention visits as well. So when you're not traveling across the globe, those airplanes aren't burning oil and gas, and all of a sudden that drops a lot. And so we've seen a tremendous dive in the oil and gas industry as well that we're quite worried about leaking to other states. And on top of all that, if you're looking for a cherry on top of all of that good news, we got hit by 2 massive hurricanes. And while thankfully the eastern part of the state's coastline did not get a direct hit, if you're in the Lake Charles area, if you're in Vermilion area, if you go up and down that western side in Louisiana, Laura and Delta had a 1-2 punch. For those of you that remember kind of what I would say the 2015 hurricane year, where you had Hurricane Gustav and Ike come in and kind of do a 1-2 punch on Louisiana, Laura and Delta are very similar. Laura came in and was a wind event, knocked down a lot of trees, power lines, tore off roofs, and then Delta came in a rain event and really saturated those impacted facilities. When we look at the industrial facilities in Southwest Louisiana and Lake Charles that are driving a lot of our economy to date, they fared pretty well. But again, what they're worried about is their people, their employees. Are they leaving? Are they going to bleed to other cities? And so the big takeaway from the impact of COVID-19, the impact of the oil and gas, the impact of the hurricanes is many of our facilities fared well, either by a facility base because of hurricane resilience, or with PPP loans. Many of those businesses are still there, but their employees are the ones that we're worried about leaving. It's a workforce issue more than anything that we're worried about going into 2021. So with all that gobbledygook of challenges we have, what do you do? What's the best step forward? Where do we go from here? And the way we look at it is the good and bad of Louisiana is many of the challenges we face in 2020, we faced for decades, and we know kind of what the blueprint is. And so I can tell you from a LABI perspective what we've done in the last year or so and what we plan to do for the next couple of years of this term to kind of help us all dig out collectively. And so if you look at that bottom foundation, if you will, in the Louisiana graph right there, in the last year, this is what we did. There was a historic election in the state capitol, not from the governor's race, because that was well documented. But what people forget is in the legislative race, there were a lot of term limits. And so new people were coming in. And so we went out and recruited candidates, talked to them about business issues, talked to them about free enterprise, and really gave them some of the training to go in and run for office. And we tried to find small business owners, people who knew how to work a budget and deal with challenges in the real world, and put them into the Capitol to try to get some real world perspective on these issues. And those elections brought in a brand new legislature that I'll talk about a little bit more in the next slide. That new legislature elected their own leaders for the first time since Huey Long came into effect. And so what you saw in the Capitol is it's a little more chaotic right now, but it's kind of ground up driven. There's no longer one person setting all the rules. It's really a kind of a coalition of different groups that are trying to figure out how to dig through this monumental year 2020. In the first session this year, they passed some meaningful tort reform, and I'll talk about that a little bit more in a second. So now we're in this second year, the end of the first year bleeding into the second year, and that's where we're dealing with fall judicial elections. We're dealing with a special session right now, which I'll talk a little bit more in a second, and future issues coming up like reforming our tax code to make it easier to grow and invest here. These building blocks are going to be the way we dig through COVID-19 impact. It's going to be the way we dig through a sinking oil and gas economy, and it's also the issues that we've had to confront for many, many years, even going back to those 1980s crash that I mentioned earlier. And so, let's see, I'm going to hit the next slide real quick. Maybe I will. Let's see. Okay, so just a little breakdown of what that legislature looks like. There are actually 21 senators and 61 new House members that we endorse, but there are new faces going into the Capitol. Typically, if you've ever hung around the Louisiana Capitol for decades, it was 3, 4, 5 people would go in a dark room, make all the decisions, come out, everyone would salute, and that was the plan. Now you've got all these new fresh faces. They're all bringing their own perspective. It is kind of a melting pot of new ideas in there, which is making it pretty interesting to work with. And also the Senate President and the House Speaker in the Capitol, typically over the years, over the decades, they would battle each other and kind of hold their cards close to the vest and kind of the last 48 hours of a session try to jam through a deal from their own perspective. Now, the House Speaker and Senate President, they're working together. They're collaborating. They're sharing ideas on the front end. We think that it leads a lot of optimism to where we can start to solve some of these historic challenges in the years to come. So in that first session early on this year, let's do a little tail of the tape. Tort reform was passed, and I want to talk a little bit about that. Usually when you say tort reform, people's eyes gloss over because they're like, I'm not a lawyer, I'm not a judge, I don't know what you're talking about, and I don't care. I get it. But this is what tort reform is. Louisiana has the second highest car insurance rates in the country. The reason why is because it's very profitable in Louisiana to drive a lot of cost in some of these settlements. We have the highest bodily injury rate in the country. In fact, it's twice the national average. So big checks flow out of courtrooms in Louisiana to people with minor injuries. And it's happened years after years after years. And as we looked at our court system, the reason why is because it was very hard to get a jury in Louisiana. In other states, it's quite easy. In Louisiana, it's very hard to get a jury of your peers to hear your case. There's also a lot of gag orders in Louisiana, things you cannot bring up in a courtroom. Again, you can't have a jury, you can't have the evidence to defend yourself, you're a sitting duck as a citizen, you end up writing big checks for these big settlements. And so tort reform this year that we pushed and passed for would allow juries into the courtroom. It would allow all the evidence into a courtroom. Our feeling is the more that happens, the more the truth shall set us all free. The more the evidence and the data will tell the story of what really happened. And if you were hurt, that check will be written. If you're not needing the exact settlement you've gotten in the past, those settlements will come down. That will lead to lower auto insurance rates for all of us. In addition to tort reform, it's brought a lot of transparency on the judicial system. Many of you may have seen in the New Orleans area, WWL and a few other places have written some stories lately about a pretty nasty racket that was going on in New Orleans where people were being paid to go in and stage wrecks with trucks, drive big settlements, getting back in payments. The FBI is investigating that. All of those things are tough to know about, but the more we shed a spotlight on that, the more we can clean up our judicial system, make it more fair, lower insurance rates for all of us, and that's the goal of why that tort reform was so big. Also, there was some minor tax and regulatory relief that passed this session. A couple of what we would view as misses is the legislature did not take a look at some of the other issues we hear. Coastal lawsuits is one thing. In the energy industry, we've seen a lot of our energy jobs bleed off to Texas, Pennsylvania, even up to the Dakotas to a certain extent. And litigation environment is something we hear over and over and over from our energy producers. And so we tried to bring some legislation to kind of put some sanity in some of those energy lawsuits. That bill did not happen. We'll come back in future sessions and try to bring some more resolution to that to hopefully bring back those energy jobs if we can. And I put on there education prep. During this session, it was earlier this year, it was the beginning of the COVID impact. We kind of missed an opportunity to work with the legislature and put some better prep in for schools. And what happened is many parents had to go through virtual schooling. Many schools were unprepared to do that. I think we all as a community got caught flat-footed on having virtual education be a good, rewarding experience for student, parent, teacher, and school alike. And if there's one thing, and as I've talked to Superintendent Brumley and others over these last couple of months, I don't think we'll get caught flat-footed again. I expect in future sessions us to have a more focused effort to have our education system prepared for more virtual learning opportunities. And on the to-do list, tax reform and redistricting. Next year in 2021, which will come up sooner than we realize, in April, the legislature will come back for a fiscal session. Two big things that will happen in that section. Tax reform is one. Tax reform means there's going to be an effort to lower tax rates and do it in a way that uses some of the exemptions and credits that aren't useful, do away with those and lower tax rates across the board. That's something we'll be working on. We think will be good for economic development. We think can be good to revitalize some of the cities and areas that many of you are worried about. Also, if you're in the New Orleans region, I would pay attention to redistricting. Once every 10 years, the United States comes out with a census. They count people where they're at. And the legislature, once every 10 years, takes that data and redraws the lines for your congressman, your legislator, your public service commission, your court system. That's going to happen in 2021. The last time we took a census, there was a lot of population movement in the New Orleans area. And since those last 10 years, a lot of that movement's come back. I expect the New Orleans area to gain some seats, gain some opportunities to bring back some representation. So I would keep a lookout for that issue and get involved or get knowledgeable on that issue because it will be huge for the New Orleans region in 2021. So what about right now? So right now the legislature has called themselves back into a special session to basically handle a couple of things. The Unemployment Trust Fund, COVID-19 restrictions, and they want to get into the emergency authority legislation between themselves and the governor. And there's also been some task forces evolved to study some issues. I'll click to the next slide real quick. These are some of the big bills on the move. Let's talk about emergency authority for a second. Typically in Louisiana, we have very broad authority given to a governor to act in an emergency. And the reason why is, think about it, we have hurricanes all the time, we have tragedies, quite often because of our location in the country. And so you need a governor to act decisively, and we've got a strong tradition of that happening. But as a month turns into 2, turns into 3, turns into several, there's been a discussion between the legislature and the executive branch. Once you start getting 5, 6, 7 months into a shutdown situation, where emergency authority is used to keep folks at home, keep businesses closed, keep people out of airports, keep people away. We've never seen emergency authority use that before. And so the legislature is saying, time out. If we're going to use emergency authority to keep folks out of commerce, we want to be more involved. So there's a couple resolutions to watch out for the next couple of weeks. They're going to try to get more involved on the front end next time this happens, and also make an effort to open up the economy more right now in the current situation. So those are two critical actions that are happening, should be resolved in the next couple of weeks one way or another. The second category is the Unemployment Trust Fund. All you need to know for this is Louisiana, like every other state, has something called an Unemployment Trust Fund. Employers pay payroll taxes into that fund and that over the years, and that pays unemployment claims as they come out. Before COVID, Louisiana had an extremely healthy fund, about $1.1 billion. Now it is bankrupt, and we are one of 27 states that now have a bankrupt unemployment trust fund. Without legislation, the triggers that go automatically into effect is big business tax increases to refill the fund and big reduction in unemployment benefits. And so right now, we can't have big taxes coming in, hurting businesses struggling to stay alive, and we can't have a huge reduction in unemployment benefits when people are out of work. So these bills you see before you are ones that the legislature is considering to put a freeze on the taxes, a freeze on the reduction of benefits, give us time to kind of slowly rebuild this fund to where it needs to be. And right now, through federal loans and other ways, there's ways to keep dollars in the fund until we figure out and get our economy back online. That's what those bills are intended to do. And then the third category they're looking at right now is what I'll call economic recovery. There's a couple of little minor issues that the legislature's dealing with and say, okay, right now, how can we stimulate some economic growth? The HB 78 is a way to give parishes more control over their own property tax and deals they can make with incoming industry. Representative Philip de Villiers has a bill to try to make it more attractive for energy companies to come drill wells here as compared to other states. And then Senator Rick Ward has a bill to try to make it easier for companies to keep inventory here, not be penalized for that as compared to move it to other states, which our tax code can incentivize sometimes. So they're in special session. They've got a couple weeks left to tackle all these things, and I'll be glad to go deeper on any of these in the Q&A portion if you'd like. That is a speed dating version of what's going on right now. Tried to be quick, tried to be top level. If you want to stay involved, if you want to get more regular updates through this session, even after this session, you can text LABI to 66866. We'll be glad to put you on our mailing list, keep you in the know for what's going on in the Capitol, because in our opinion, an informed constituency is a more involved constituency, and we want you all to make your voice heard. And here's a couple other things we are doing coming up that if you'd like to participate in, we'd love to have you do that. And so with that, I would be glad to answer any questions, comments that folks may have dialed in.
Okay. Remind the audience that you can use your Q&A button if you have a question. I have a two-part question. Stephen, how do business, and I've always been curious about this, how do business and manufacturing see the business climate of Louisiana, A, and B, what's the biggest impediment to business and manufacturing locating in Louisiana?
It's a great question. You know, if you think about Louisiana, we have many attributes which should be very attractive. You know, obviously we have tremendous natural resources. Some of the infrastructure we have is very impressive. Our pipelines, the river, the ports, all those things, our access to the Gulf of Mexico and shipping opportunities. We have a lot going for us. But we also have a couple impediments. And so what we hear, one, legal climate is something we hear quite frequently. If you are an energy company, you're worried about investing big dollars here, you're worried about the lawsuit climate. I mentioned the insurance crisis earlier. And so legal reform is something we have to get more serious about if we want to attract some of that investment. The other piece is kind of quality of life type stuff. If we're competing for kind of the major cities in the South, let's say we're competing with Nashville and Atlanta and Charlotte and Houston for a big job or a big company to come here. A lot of times what we hear is say, look, we like what you can offer, we like what is here on the table, but we're worried about the local public school system. Can our mid-level employees come in, afford a house, afford a school, afford to live in that community? Is there the quality of life type stuff? And so I think we have to refine our legal climate. We have to make a tax code that's more competitive with Texas and Florida and Tennessee and Georgia, some of the big competitor states. And we've got to, sell our quality of life very well. We're very good at the festival side. We're very good at the joie de vivre. It's where you get into a good quality local public school and a safe neighborhood to live in. That's where sometimes we've got to do some work to clean up.
You talked about the most recent elections, and obviously with term limits, there was clearly a huge turnover in the legislature. This independent streak that you're seeing out of the legislature today, how do you think that's going to impact the growth in business, our growth in Louisiana, and the business climate in Louisiana?
I think it provides opportunity, but no guarantees. I mean, look, the good news is when we went out and did our boot camps, we tried to go talk to business people, and really people who are behind a counter, who have dirt under their fingernails, real business people, and asked them to run for office. And the first thing they all told us was, I can't run for office, I'm not a lawyer. And we had to tell them, look, the last thing we need is more lawyers. And look, I'm a lawyer, so I can say that with immunity. But like, the last thing we need is more lawyers. We need people with real world perspective. And so thankfully, a lot of those folks decided to run. Now, they're not polished politicians. I think that's an asset. I think they allow us to view issues we've battled for decades in Louisiana with a new, fresh approach. They're not scared of all the hot stoves in the Capitol. They're willing to take risk and chances. We saw that on tort reform. I think next year on tax reform, we're going to see that, and it's an opportunity to really make some big strides. Now, just because it's an opportunity doesn't mean it's guaranteed to happen. There has to be an educational process. We are very active in trying to get this information out there. We do a lot of charts and graphs and testimonials and things like that. We connect them with a lot of real-world perspective because we want them to be bold and be informed when they do it. But in that tax reform piece next year that I think is so critical, I do think we have to simplify in Louisiana. You know, if we look at who our big competitor is, it's Texas. And Texas sells no personal income tax. They sell lots of space. They sell lots of public schools, lots of clean, safe areas. We've got to fight on that battleground, and I expect tax reform to try to lower rates and simplify as much as we can to be the tip of the spear next year using this new legislature to get it done.
So if you could pick one element of tax reform that you think would transform the business climate in Louisiana, what would that be?
It's a great question, and I think it depends on what industry you're talking to. I'll kind of give two pieces, though. One, if you're a small business retail, if you're middle business retail, I would say the way we collect sales taxes is a huge challenge. In other states, let's say Texas, if you are a retailer and you sell in multiple parishes, in Texas, counties, you pay all your sales taxes to one state entity and they distribute that to the local counties. In Louisiana, every parish has a collector. So if you are a retailer in multiple parishes, you're subject to multiple audits, multiple assessment values, multiple collection forms. It is very complicated if you're a small business. So it's an impediment to growth of small business. So we are trying to work with the legislature to create a process to where we can have a centralized collector, make it easier for small business especially to comply with the tax code, but not be subject to an audit trap left and right like we have here in Louisiana. So that's on that piece. On the larger piece, on the larger company piece, I personally think when it comes to income tax, you have to know who you're competing with. And Texas, Florida, Tennessee, they don't have income taxes. We can't get to a zero state income tax. We can't get to a zero income tax, but we can use exemptions and credits that aren't useful, repeal those and use the savings to lower those income tax rates where the state will still receive the same amount of money. It'll just be easier compliance for most business because instead of having to hire an army of CPAs and accountants to find all your exemptions and credits, you're just paying a fair, accessible rate. And also, when we're trying to go out and recruit big companies, we don't have to say, if you hire the right army of people, you can get the same rate. You can just say, look, here's what you're going to pay if you move here. It'll help us in economic development efforts.
Okay, last question. Question from our audience. How do you see the green economy, or how does LABI see the green economy impacting or potentially impacting the recovery of business in Louisiana?
You know, it's a great question. When it comes to the green economy, look, they're from just an economic perspective for Louisiana.
Like wind power.
Yeah, there's good and bad of that. Obviously, we have opportunities offshore. Some of the wind patterns in the Gulf are not as strong as they are in the West and all that. But from a technology perspective, natural gas is the cleanest of the natural resource, the oil and gas derivative resources. And we have a lot of access to natural gas here. We have the ability to freeze it and liquefy it and send it overseas. And so as more traditional fuels like coal and others are being used less, it puts more of a need for natural gas around the world, quite frankly. And so we have the ability to be a supplier of the world with a natural gas perspective. When it comes to some of your more traditional green, like solar and hydro and things like that, the reality is there's a lot of research still going into that to make those more mainstream effective. And I think Louisiana has the potential to be on the forefront of that, especially, I would say, in hydro opportunities. Just here in Louisiana, there's the Water Institute for the Gulf that was put in place a couple of years ago to try to draw down a lot of research dollars from the Department of Energy and others to try to figure out how we could harness the power of the Mississippi River, harness the power of some of these strong water currents we have here. If we can ever figure that out, because we have more water per capita than any other state in the country, if we can ever figure that out, we can be a provider of that. But the truth is right now the technology is not there. And so the best way that a green consideration helps us economically is that it puts more of a need for natural gas around the world, and we have a great opportunity to be a great supplier of natural gas for the world's economy.
Well, Steve, I want to thank you.
Thank you.
Great presentation, good information. Audience, we'll now take a 10-minute break. So we have a poll question. We'll do the poll question when we come back. So thank you.
Thank you.
Gulf Coast Bank and Trust is giving our customers the power to bank anywhere 24/7.
It's about doing the right thing for our customers.
And with our mobile banking app, you can make deposits, check balances, transfer money, pay bills, and more. Gulf Coast Bank and Trust, the bank that cares about you.
Greetings from Southwest Louisiana. My name is Andrew Van Cherry. I work for Latter and Bloom in the Southwest Louisiana market, primarily Lake Charles and Sulphur in the industrial and office sectors. And we're about 30 or 35 days after the impacts of Hurricane Laura. It's going to be a tough road here, as about 30 to 40% of our office market is totally offline. The majority of that may not come back in the next 24 months. And then in the industrial sector, we're looking at almost the same kind of outlook. We're going to make the best of it. There's going to be some opportunities for rebuilding, but for the time being, it's kind of a dog show, and we're not looking at the faces, but the back ends. Call us if you need help. Thanks.
I'm Chris Town with NAI Latter and Bloom here in Baton Rouge. I work in several disciplines, but will speak briefly about the impact of the pandemic on office leasing. The pandemic has disrupted this space significantly, causing sublease space to become a major topic of discussion. That relates to work from home, which is also a great discussion in the C-suites across America. You've heard a lot of discussion about the large tech firms bailing out on the corporate office space, specifically Facebook and Amazon. However, Facebook has just recently purchased the REI headquarters in Bellevue, Washington for $365 million. They've also leased over 700,000 square feet in New York City across from Penn Station. Amazon has done likewise in the Lord and Taylor building in New York City. The work from home phenomena is gaining steam very quickly, thanks in large part to the pandemic. This is going to affect the co-working space. It's going to affect the corporate cultures of major corporations. This effect will happen much more in the major metropolitan areas and also in small to mid-sized markets. According to a recent poll, approximately 30% of the workforce would like to work remote, either full or part-time, and 70% of the workforce would like to return to work either majority time or full-time. A full 44% of that 70 would like to return to work in the office 5 days a week. So these will be interesting calculations for all of us to consider moving forward in the corporate office space. Thank you for your time.
Hi, welcome back. We'll do another poll question right now, and while we're doing the poll question, I'll introduce our next speaker. Our next speaker is Kati Hyer. She's the Vice President of Communications for the Louisiana Oil and Gas Association, LOGA, as they say.
That's right.
And her topic is very important to us here in Louisiana. Where is the oil and gas industry today? No small order there, no small question. But
That's right.
It's all yours, Kati.
Thank you. And thank you so much for having me. I love talking to real estate people. You guys are some of my favorite people because I used to work in title. And so I know how hard you guys work. I know how the grind never ends. I know the business-mindedness you have to have, just the endless drive. And that is a value you share with the wonderful people of Louisiana's oil and gas industry. I'm going to sit down now. And those are the people I get to serve every day as the communications director, essentially, the vice president of comms at LOGA. Every day we serve the state's independent oil and gas producers and the service sector that services them. So, in fact, most of Louisiana's oil and gas businesses are small businesses. And so 2020 has been an incredible year for everybody in so many ways, but for oil and gas, it has been a double whammy. That is because 2020 has been the perfect storm. Back in March, we had our annual conference where we were celebrating everything that it meant to be in oil and gas in Louisiana, from the economic benefits and the jobs to just every bit of far-reaching, just wonderful things that our industry brings to the state. Well, that same weekend after our conference, OPEC, the Organization of Petroleum Exporting Countries, decided that they were going to no longer stand by previous agreements, and they were going to put a lot of oil on the market. They were going to flood the market with an oversaturation of supply. This was a stunning revelation after years of working together with OPEC. So this increase in supply was historic, never before seen. At the same time as that way huge influx of supply of oil came in, the pandemic started hitting, and people started not traveling as much, airplanes weren't being used, people were not getting on cruise ships, and indeed some state-to-state travel was forbidden, as you all well remember. So as we can all think back to our 6th grade economics class, when you have too much supply and not enough demand, there's only one place that prices can go, and prices are going to go way, way down. And that is what happened. As you can see on this chart, this is looking back at the last 2.5 decades, almost 3 decades. Oil and gas are truly global commodities. It's not just a statewide commodity. Obviously, there is travel everywhere on every part of the planet. This global commodity has always had a really fine balance of a surplus or a deficit, right? So just enough oil or not quite enough, let's bring it up. 2020 happens, and boom, we have so many 20 million more barrels per day than we need. People were not using it, and Saudi Arabia and Russia just decided to put way more on the market than was needed. If you look back at what some of these foreign ministers said around their intent, they were intending to use capitalism to their advantage and truly get rid of the American oil and gas producer, the American energy producer, because at those low, low prices, it was very, very difficult for an oil and gas business to stay afloat. So what does that mean? Well, we all understand you have to have a good price, you have to have a good market for whatever it is that your product is. And so Jim Burkhardt of IHS Markit said, if there is no international agreement to curtail oil production, i.e. if we can't get OPEC back in line, back in agreement, then brutal, unadulterated market forces will bring the oil market into balance. The law of supply and demand are fierce and extreme conditions, and we all understand that. If there are no buyers, it doesn't matter how many people are listing their houses, right? Supply and demand, so important. Well, OPEC decided they were going to make those cuts in May. They were historic cuts. You may have remembered seeing some headlines here and there. It wasn't enough. They may have been historic cuts, but the historic glut was way too much for those cuts to overcome. And so that is still the environment we find ourselves today. And then the next problem you end up running into is where you're going to put it all. If you are an oil and gas business and your business every day is drawing minerals from the ground so that they can later go to a refinery to be turned into the products that we use every single day, from healthcare, sterilization products, to everything involved in transport, everything in food supply and food sanitation, all of those products, computing, technology, well, there's no place to put it. So we came to a point in April where, for the first time in history, oil prices were negative. How can an oil price be negative? Imagine if you had a taco shop and all of a sudden everyone on the street, everyone in town decided to open a taco shop. Everyone decided to sell their tacos. Tacos got cheaper and cheaper and cheaper until finally, when a customer came into your restaurant, you had to say, here is a plate of food and I am going to pay you to take it. That is what happened to our industry in April. It was staggering. It was never before seen, and it was a very difficult day economically. Oil is no longer at negative prices, negative $40 a barrel. We are now, the last check on Monday, sidebar, if you go to the LOGA website, www.loga.la, every week I publish the LOGA drilling report, and we look at prices, we look at the U.S. rig count, we look at all of these good indicators as to the health of the industry. So Monday, I check the prices of oil and natural gas and all of these things. And on Monday, the price of oil was $39. This is a price point that is very difficult for oil and gas producers to stay in business at. And today, most economists agree those prices are predicted to remain in that 40s area until 2022 or longer. And you can imagine that as we see this new normal playing out, where we're not traveling as much. When we go to school, it's in a restricted way. When we go to big places, we're going to spread out. We're going to have restricted numbers of people allowed to get together. And so you can imagine that the demand for products like oil is going to continue to remain suppressed as we're in a continued COVID-19 normal. Same thing goes for natural gas. This is going back just a year, and you can see it has been a wild ride for prices for natural gas producers. Up and down all over the place, and that high point on the far left, $2.77, that is a terribly low price already. That is a very difficult price point for things to be economic for natural gas producers. 2 years ago, 3 years ago, natural gas prices were more in the $4, $5, and $6.50 ranges. That's where you can start to see some capital investments, where you can start to see new projects taking place, real investment coming around. These prices are barely break even, and in many cases they are less than break even points. I put $1.60 there because that was the lowest price natural gas had hit in quite a long time. Since I first put this presentation together, it has gone back down into the 150s, just another symbol of how difficult it is for natural gas producers to make it in this environment. And you can look and see this nationwide. The rig count is something that just looks at how many new projects are going on right now drilling for oil or natural gas. That's what the rig count is, right? It's like a construction project tally, a good crude marker of what's the economic health of an industry. And for us, the rig count is the economic health of our oil and gas industry. And nationwide, just a year ago, we were at 1,000 rigs. This year, right now, we're at 269. Just 269. It is very suppressed. It's very difficult. But that does not mean that that all is not well. Things are going to come back up, and I'll tell you about that in a minute. So after the crash in April, after OPEC broke down in March, we decided we really needed to drill down into the numbers. Our members are all over the state of Louisiana. Some of them are even doing business in Texas. As you heard Stephen with LABI talk about the overly litigious nature of the state. Those things and other economic challenges make doing business in Louisiana difficult, so we've seen our members start to do business in Texas and New Mexico and other producing states around Louisiana. That was a sidebar, but very important. So we decided to ask our members, what do you really need? What does this crisis truly mean to you? Our oil producers told us, on average, they needed $37 to break even, to simply cover their costs. Well, that is an average. Not everybody is at that same price point. Some are a little lower, some are a little higher, but either way, we are in the barely break-even point week to week ever since March. What that has ended up meaning is huge economic fallout across the state, and I'll detail that in a bit. $37 for oil producers, $2.01 for natural gas producers. Last week we were at $1.89, so you can see each week in and week out, prices change and really impact these small businesses. So what can we do? What is in our control? We're not in control of Saudi Arabia and Russia. What is in our grasp that we can improve, that we can help to change for Louisiana? There are two huge things that are on our radar right now. There are always a laundry list of priorities, but the two things right now going on are, number one, yes on Constitutional Amendment 2, and number two, suspension of severance taxes. This is a bill going through the legislature right now to help incentivize drilling, and I'll come back to that in a minute. So what will happen with this price crash? Well, as of March, there were about 33,000 producing wells. Now we're at 31,000 producing wells. And we have asked our members, and they've told us 4 out of 5 members are already starting to shut in a well. Well, what does that mean? Well, every well has staff, they have team members, they have vendors, they have people coming to make sure that all of the equipment is running smoothly, to make sure that everything is set up with the pipelines. All of the investment in a well translates to jobs, translates to taxes in communities, translates to spending at retail and in real estate and restaurants. So when a well shuts in, that has a ripple effect across the local economy, and we're starting to see those already start to shut in. And this industry is a bedrock industry. Oil and gas represents $3.2 billion in wages every single year. Every single year we employ 33,000 people. That changes from year to year, and this year we're waiting to see the stats for where we are now. If you look in the HOMA MSA, the employment there is 6,400 people are tied directly to oil and gas. That's wages of $600 million. If our projections continue under these price circumstances, we're at risk of losing $400 million in wages. That's a lot. What it means is for every one person employed in oil and gas, 3.7 more are employed elsewhere in unrelated places around the state. According to Dr. Lauren Scott, we are the top weekly wage producing industry in the state. And those dollars impact other businesses, they impact other wage earners, they impact 3.7 on average more jobs outside of just oil and gas. So when we see the consequences of the price crash on the oil and gas industry, it has huge implications for the people around it. So much so that we've started to see bankruptcies come up. We've started to see people closing, or there's been a lot of mergers and acquisitions that we've been seeing in the headlines. Haynes & Boone has a oil batch bankruptcy monitor, and they said that in 2020, bankruptcies are up 66% since 2019. So all of that to say, we are facing a very difficult year. But like I said at the beginning, the oil and gas industry is resilient. We are hard workers. We are full of faith, and we are going to figure out a new normal. So those two solutions that we come back to right now for two specific things we can change, we are always going to be on the lookout, by the way, for better regulatory environment, better legal environment, better taxation environment to make Louisiana competitive and fair and predictable. But right now, the two things in front of us are HB 29. This is a severance exemption bill in the special session right now to incentivize new drilling. The idea here is if it's so expensive in the current price scenario to continue drilling, how can we make it less expensive so people come back, they do invest, and they are able to employ workers, they're able to employ vendors. So this bill would help to do that by saying, let's say it costs you $2 million to drill a well. Well, once you have paid all of those costs, then your severance taxes, which by the way, in Louisiana are the highest in the continental United States at 12.5%, those would be delayed until after you finished paying all of your startup costs. The second thing is we need to pass Constitutional Amendment number 2. If I read this to you right now, you would fall asleep at your chair. Essentially, it asks, do you allow the income method for assessors to value an oil and gas well? Now, you see assessors all the time in real estate. And so you probably know that there are 3 ways to value a property. There's the cost approach. What does it cost to replace this property with all new parts, or all new pieces, or all new construction? There's the fair market value approach. What have houses like this house sold for recently in the same neighborhood? That's the second approach, the market approach. And then the third approach is the income approach. How much does this property produce in income? Well, income-producing properties in Louisiana are allowed to use the income approach. All of them. All of them except a drilling well, which, as it produces minerals, oil or natural gas, is an income-producing property. This amendment will let assessors have the capability to consider the income approach when they assess an oil and gas well. This is hugely important because today, let's say you have 2 identical wells. One produces 10 barrels a day, one produces 1,000 barrels a day. This one is more valuable because of the amount, right? Clearly we can see that. Today, assessors are not allowed to take that element into consideration when they assess the value of that well. The result is there are many under-assessed wells, so parishes miss out on the dollars, and there are many over-assessed wells, so businesses already hurting are burdened with an unfair assessment. Constitutional Amendment 2, I am proud to say, and I get the pleasure of saying, has unanimous bipartisan support. When it was a bill in the legislature, there wasn't a single nay vote. And after decades of dispute, industry and assessors are all on board. We agree together that this is the right way forward. So I encourage everybody to vote yes on 2 to help predictability and fairness for those oil and gas wells in Louisiana. So what is next? What is our forecast? Well, of course, we are waiting for price to see what will happen with prices. As prices go up, it will help Louisiana. That's out of our control, but we're waiting for it, and we know it's going to come because every economic forecast out there has looked and said it will recover one day as demand recovers. There's a couple of projections out there. One came out from the Energy Information Agency today that said before COVID, the projection was in the next year or so for demand to be at 106 million barrels per day. Now in a new normal, they've projected it to be at 104 million barrels per day. So you can see the change is not so great, but we're still waiting to see exactly how that plays out. What does that look like for COVID 2.0? We're waiting to see, will we have to go back to stay-at-home orders? Will transit and transportation be shut down again? All these things affect demand, and so we're watching those closely. The presidential election could have major implications for America's energy producers, and we're watching for that too. Constitutional Amendment 2 is the only thing within our control of the 4 on this screen, and so we're encouraging everybody to learn more and vote yes on it. We're on every single social media that you could choose from, so reach out to us there. You can always find my contact information online, and if we have any questions, I'm happy to give my best at answering them.
Katie, the most interesting thing that you said was the quotation. I don't remember who said it, but the brutal, unadulterated market forces will bring the oil market into balance. In the global COVID context, that's true for every market these days, for every category that we're in. But having said that, are there any plans to store more oil or natural gas in reserve while there is such a glut in the marketplace?
That is a great question. Federally, there's the Strategic Petroleum Reserve. This is where Congress can say, okay, in times of war or in times of other big emergencies, we can draw on a federal supply to make sure that we have enough petroleum products should the need arise. And so there are some bills working their way through Congress right now to try to get a little more of the Strategic Petroleum Reserve, that SPR, to make storage available. That's happened in a couple of ways already. And so the Department of Energy is continuing to look at those options for us. So that's in development, and that's happened a little bit earlier in the summer. But overall, that's not the silver bullet, to what the industry is facing.
The whole question of the fossil fuel industry has been a huge issue in the presidential election. I mean, if you could comment, what would happen? How do you see the presidential election impacting the oil and gas industry in Louisiana?
Yeah. Look, oil and gas is not going anywhere. I mean, if you think about your neighbors, your community, can you imagine everybody selling their cars tomorrow for a car that didn't use petroleum products? Or could you see the economic feasibility of not using any plastic in a hospital or in an agricultural sense in a grocery chain? The reality is oil and natural gas are really easy targets during an election. But the truth is a lot more nuanced. Oil and natural gas industry, especially in Louisiana, are the #1 leading industry for restoration dollars in our coast. We have brought down emissions 77% since the 90s, while GDP grew almost 200% at that same time. We are the leading investor in cleaner solutions in the environment. And so really there's a lot of nuance there, but we're not going anywhere. And no matter who is elected, oil and natural gas are going to remain a really important part of our economy and Louisiana's economy for the foreseeable future.
Pre-COVID, LNG was a very fast emergent industry, clearly impacting the economy of Lake Charles. You care to speculate on how LNG will fare in post-COVID, post-hurricane, and its impact for not only Lake Charles but for Louisiana?
Yeah, you're right. LNG is a huge part of the economy in Louisiana and in the Gulf Coast. 2019 was a huge year for investments in LNG. You may remember the president visited Hackberry for one of the trains coming online in LNG there. What's important to understand is LNG projects take a lot of time, a lot of capital to get started, 5 years, 6 years, 7 years, and then they are online. Those projects are online for 20 years or longer. So when companies make decisions about LNG projects, those are huge capital expenditures. And so today we are seeing, some of those projects are pausing. So people employed in LNG are waiting to see what is the future of those projects going to look like as they consider, okay, what is the use of LNG going forward? So in a new COVID normal, we are rerunning all those models. We're seeing these companies reconsider all the economic, all the underlying models that they're using. So those aren't going anywhere either, but there is a little pause going on as people reconsider their investment. Because those are such long-term projects. 1 year, 2020, is a blip on the radar in the grand scheme of things. So these projects are going to come online. It's just a question of when are we going to get them restarted again.
I asked Stephen Waguespack a similar question. How do you see the green economy impacting the oil and gas industry in Louisiana?
Yeah, I mean, a lot of these alternative sources of energy need petroleum products to exist in them of themselves, like a wind turbine. It's made entirely out of plastic. Just one of many examples. So what we're really seeing, and I mentioned earlier the nuance of it's not truly a black or white, you can only be renewable or you can only be fossil fuels. There's really an all of the above approach that a lot of companies are taking. And in Louisiana, we have a new carbon sequestration market, which is really exciting. Senator Sharon Hewitt had signed into law Senate Bill, I think it's 286, in the first regular session this spring, which allows for a new carbon sequestration marketplace to take hold in Louisiana. And what that means is that companies can come and capture carbon, remove it from the atmosphere, and then put it on a market so that there's a free market basis for reducing some of those emissions. So we're seeing more and more of those solutions coming out, a market-based solution to figuring out, the problems we have with emissions or the challenges we're facing.
Okay, our last question.
Sure.
And I've asked this to most of the speakers today. If you had a crystal ball that was not cloudy, what is the oil and gas industry's expectations for 2021?
If 2020 has taught us anything, it is how to pivot. The beautiful thing about capitalism is it forces us to reconsider, look back to our core values and figure out how to go moving forward. One of my members shared that in the 90s, the prices for his product came down to what we would see today as miraculously high. Back then, he thought, there's no way we're going to survive. But they did. They figured out a way to become more efficient, to get better at the processes, to figure out ways to streamline. That's going to happen again, and we are just going to continue to innovate, to be smarter about all of our processes, and no matter what 2021 throws at us, we'll be ready.
Okay. Kati, we certainly thank you.
Thank you.
I think there were a lot of folks that were interested in what you had to say. We have more time, you were saying?
No, we'll find out.
Okay, all righty, I'm sorry. All righty, that will take us to our break, and we'll see you when we get back. There are a couple videos that you might want to take a look at as we close.
This is more than a venue. This is a dream.
Make New Orleans the city that works and works well for everyone.
As the city, state, and nation recover from the COVID-19 pandemic, the Convention Center is committed to working with your small business to restart your growth. This is more than a venue, Louisiana. This is opportunity. Small businesses download the SEB Connect app. Connect with the Montreal Convention Center. Connect to more.
We miss you, indeed. We miss you being in New Orleans. We also miss doing what New Orleanians so often do best, welcoming you to our city, telling you about our favorite places, and watching you truly experience the absolute beauty and indescribable magic of this incredibly special place. Everything that you know and love about New Orleans is not only here waiting for you, but it's better than ever. We've been busy getting ready for your arrival and have considered every detail of your visit with world-class dining, a brand new airport, new museums and attractions, and hotels to fit your every need and desire. Our world-class convention center is completing a beautiful new pedestrian park and is beginning renovations to other facilities. We'll even have gumbo on the stove, and our musicians are tuning their instruments. So when it comes time for you to return, we'll welcome you back to our table and celebrate with you our 300-year-old traditions. And we know that you will create new ones along the way.
Good morning, New Orleans. We
love you, New Orleans.
Just know that we're thinking of you here in the Crescent City, and we can't wait to see you soon.
Love New Orleans. When people come, they never leave, because we're swinging that way. The sun shines so bright. The breeze is so nice.
The Preservation Resource Center of New Orleans is a 46-year-old nonprofit dedicated to the preservation and revitalization of New Orleans' historic architecture, neighborhoods, and cultural identity through empowerment, collaboration, and service to our community. We believe in the authenticity of our wonderful 302-year-old city and know that our historic buildings and neighborhoods are at the very soul of who we are. It's why people live here and why millions of people each year come to visit. We are the region's premier educator, teaching people how to buy, renovate, and maintain historic properties. We also have a variety of wonderful programs every year to give tours, lectures, and decorating tips for people interested in New Orleans style. We offer historic house specialist classes that train realtors on the unique history of our city's properties and how to best market them. We are advocates at heart and fight against all unnecessary demolitions and promote projects that work to make our city a better place. We also fight to keep policies in place that help encourage revitalization projects, such as the historic tax credit on both the state and federal level, which have made amazing projects possible in our city, such as the Ace Hotel, the Sanger Theater, and the Pythian Market. Our award-winning communications team produces a monthly magazine, Preservation in Print, publishes books, and has fantastic social media feeds. Check us out on Twitter, Instagram, and Facebook at PRCNO. We are the region's only holder of historic facade easements, and our Revival Grants program gives free home repairs to low-income homeowners in historic districts. Our events cannot be beat. You may have heard of our holiday home tour in the Garden District, which is going virtual this year. Check us out, and our Revival Gala. Please visit us at prcno.org to check out our merchandise and become a member. Together, let's keep New Orleans authentic.
Quite interesting. As you know, business, politics, and economy is always that mix. And we thought it would be a good idea to hear from our NAR lobbyists in Washington on what's happening in DC as it relates to the real estate industry. So we have 4 speakers today, 2 from the Democrat side, 2 from the Republican side. And we have Joe Harris, who with the House Democrats, Helen Devlin with the House Republicans, Vijay Yaplapadi with the Senate Republicans, and Colin Allen with the Senate Republicans. I'm sorry, Vijay's with the Senate Democrats, and Colin is with the Senate Republicans. So should be an interesting discussion. And ladies and gentlemen, take it away.
For inviting us to do this, we're happy to join you. And as you mentioned, it's at DC they like to call it the 4 corners. We kind of run our lobbying shop that way, divided by house and by party and by chamber. So what we wanted to do today, the 4 of us, is give you a quick political overview of what we're seeing and hearing and what might happen over the next couple of weeks, and then highlight a couple of issues that we've been tracking right now that we definitely think are going to be important next year as well. So if it's okay, I'd like to go ahead and turn it over to Joe Harris and Colin Allen to give us a kind of a crystal ball political update, what's happening.
Yeah, thank you, Helen. Joe Harris. I work largely with the House Democrats, as was mentioned. Great to be with you all today. What a time to be alive, huh? It's if you think things are difficult to call at this point, you would be very correct. I wanted to start off a little bit by talking about the stimulus bill, the next stimulus or COVID relief package, which may or may not be happening. There's been a lot of back and forth between the Speaker and Secretary Mnuchin. So it's very difficult to handicap the likelihood that something is going to happen before the election. But I handicap this as unlikely, but not impossible for a couple of reasons. First, Speaker Pelosi and Secretary Mnuchin have a lot of time into this. The conversations have largely been in good faith, but as with any negotiation, there are a lot of things, a lot of roadblocks that are difficult to overcome. They're still fairly far apart on the top line number. And as my colleagues on the call know, it's very difficult to get to any other part of the negotiation if you can't agree on the top line number. But state and local funding has always been a hang up in these negotiations. Last I checked, the Democrats want $346 billion. Mnuchin offered $300 billion. The federal unemployment insurance benefit, Democrats want $600 a week. Republicans want somewhere around $400. And then, of course, the business liability piece that the Republicans want, the Democrats want enhanced worker safety protections to go along with that. So they are apart, but they are not far apart, which for me leaves the door open a bit. There's also been some talk about doing a more targeted legislation, such as just sending more stimulus checks out to folks, or just doing another round of PPP funding. As Majority Leader McConnell announced this morning, the Senate will be voting on next week. But again, here, House Democrats have been pretty insistent on wanting a bigger package. So if the choice came between doing something more scaled down, like a targeted PPP bill, or doing something along the lines of what Mnuchin is negotiating, I think they'd go for the bigger deal if they went for any at all. The second issue that I think gets overlooked in all these discussions, and the reason why I'm not ready to shut the door yet on something getting done between now and the election, is the fact that on a lot of the Zoom calls I've been on, I sense a real frustration with a lot of the moderate, centrist, pro-business Democrats who are, they're anxious to get something done now. And for a couple of reasons. One, vulnerable Democrats want to be able to point to something as they're back home campaigning. And they're all back home right now because they're all in work district. And second, a lot of people feel that if there is a President Biden, he will be able to pursue something like an infrastructure bill as his first big policy goal, rather than getting bogged down by another coronavirus bill. I kind of remind people that the Problem Solvers Caucus, which is made up of 25 Republicans and 25 Democrats, kind of revived the stimulus talks in the first place. So it is not out of the ordinary that you could get some new Democrats in the House to really put the pressure on Pelosi. But the pressure is there for her to, give folks in the caucus something to talk about when they go back home. So that brings me around to talking about the political forecast a little bit. So I just said that Pelosi is under a lot of pressure with these negotiations, but in my view, she's done a very good job heretofore of keeping the caucus sort of together. The fact that most pollsters are not sensing that the Democrats are in any trouble of losing the House in the next Congress. In fact, many believe that they're going to expand their majority slightly. I think Speaker Pelosi deserves a lot of credit for protecting those vulnerable members who flipped those Republican seats in 2018, and the more senior Democrats who, quite frankly, won in districts that Trump won. She was very cognizant about the types of bills she put on the floor. She resisted calls from the Justice Democrats to vote on a Green New Deal or Medicare for all. Instead, focused on the coronavirus response, the economy, healthcare. So I think she deserves a lot of credit for that. In terms of the likely priorities for House Democrats after the election, I think the CR expires December 11th. Fortunately, flood insurance will not be one of those issues, since the last CR included a full year extension until September 30th, 2021 on flood. But the big thing is going to be COVID. Are we going to do something before the election? Are we going to do something in the lame duck? Or are we going to punt it to the next Congress? And I think all those questions are difficult to answer without knowing who's going to be running the Senate and who's going to be in the White House. But no matter how this shakes out, I can tell you that NER is very well positioned because, all the folks you see on this call and some that you don't have done a very good job of fostering those relationships, staying in touch with members, even during this pandemic that we're in, and enforcing that idea of the importance of real estate issues, which tend to be bipartisan. So in many ways, we unify at a time where it's very divisive. And I think we're very well positioned to influence those talks, whether they be tax reform to respond to the impact that COVID's had on the economy and small business, or the vaccine, whatever the conversation is, we're very well positioned to have those talks during lame duck and in the next session. And with that, I'm going to kick it over to Colin, who's got a lot more going on in the Senate than I do in the House with the election.
Thanks, Joe.
Now.
Yeah, hey, look, Joe did a really good job, I think, of covering the legislative outlook here. I think, he kind of blew my breaking news there. But the Senate will be voting on a second round of PPP and maybe some additional economic stimulus next week. As Joe kind of noted, we expect this to be largely posturing. The way it was kind of put out there, it seems like it's maybe more of a political effort than a serious legislative effort. So we do expect them to have a vote at some point next week on PPP. But the really big thing that's going on in the Senate right now is Supreme Court hearings. We've had Judge Amy Coney Barrett was nominated to fill the late Bader Ginsburg's seat. The Senate is moving very swiftly to confirm her. We're on day 2 right now of Senate confirmation hearings. Expect those to go through this week, and barring anything, kind of breaking in those hearings, or any of the background information that they do, expect Judge Barrett to be confirmed and become Justice Barrett here in the next couple of weeks. So we've got, you'll see a lot. I think in these hearings, you'll see some focus on the Affordable Care Act, on healthcare, because it's one of the big things that'll be, kind of a breaking. It's on the November docket. So it's one of the next things up for the court to consider. It's also a political decision too. Look, if you can't really slow down the confirmation hearings or block the judge, you don't want to appear like you're beating up on a very established female judge or being anti-Catholic. So, what do? You change the discussion, right? We're going to talk about healthcare. So you've seen that in a lot of the confirmation hearings, is that rather than attacking the judge directly, you're having a lot of discussion about things that she could possibly rule on here in the future. So I think that's very much what you're looking at. So that's what we're looking at on the legislative and the actual congressional action. But the Senate's really where it's at on the electoral side, I think, coming into November here. I was just reading Charlie Cook's latest analysis before I got on the call here. And he says to not to take any attention away from the from the House, but he is currently taking the over on the high side of Republican losses. Actually, I think Will was saying that if Republicans lose another 14 seats, they'll have lost more seats than Gerald Ford did during his term, which was apparently the high water mark for. So, look at Charlie Cook, not endorsing him. I used to work for Larry Sabato, and I think Helen mentioned the crystal ball. So, look at the crystal ball as well. But for you political junkies, there's a lot going on. On election night, I think there's a few Senate seats to be looking at. You're going to see, and actually in the Supreme Court hearing, you've got, I'll start there, the Supreme Court, you've got 3 fairly high profile Senate races represented on the Republican side, Republican members, incumbents who are facing pretty strong challenges. Senator Graham from South Carolina, who's actually the chair of the committee, Senator Ernst from Iowa, and Senator Tillis from North Carolina. And then on the Democratic side, you've got Senator Harris, who's the vice presidential nominee. So you got a lot of people with a lot to be interested in there during these hearings. And as you've seen already, if you've been paying attention, it is not going as a chance missed for any of those folks. They're you making the points. I think the Republicans are glad to be talking about Supreme Court. It's something that they think will drive their base and benefit them at the end of the day, kind of bring folks home. I'd say that's especially relevant in North Carolina, where you look at some of the polling and it kind of looks like the Republican base maybe hasn't coalesced around Senator Tillis where he would certainly like to. And then you got Senator Harris again making the pitch for herself and for Vice President Biden in the national arena. So those are a couple of the things. I'd say like kind of frontline, right? We're looking at Alabama and Michigan on the Democratic side as the probably the highest profile races. On the Republican side, you've got Arizona and Colorado. These are kind of the 4 that people view as the most likely to flip potentially. And then you kind of go down and you notice Vijay probably feels pretty good on this. You notice that the Democratic side falls off after that, and it's all close Republican races. Again, mentioned Senator Graham in South Carolina, Senator Tillis in North Carolina, Iowa, Montana. I think those are and Maine and Georgia. And the interesting case about Georgia here, again, if you're watching on election night, we may not know the outcome of the Senate races until well into January, because we've got two senatorial elections, one special and one regular in Georgia. And Georgia is one of these states that has this wonderful 50% plus 1 rule. So if nobody gets, none of the candidates get 50% plus 1 vote, we would end up in a position where there'd be a runoff. And there is the potential, based on the polling that you're seeing right now, that both of these races could go into a runoff and wouldn't be decided until January. So if you have any family, know anybody in Georgia, it would be a good time to just move into a cave if that's the case, because you are not going to be able to open a newspaper, turn on your phone, listen to the TV or the radio without hearing a political ad. There's just going to be gobs of money spent there if the control of the Senate especially rests on the outcome of either of those 2 races. So I mean, that's kind of the interesting thing, and again, we're working with a close majority in the Senate. We're 53-47 right now, so it's going to be a couple of seats either way. I think however this shakes out, again, if it shakes out on election night, it's going to be a pretty narrow majority, either a narrowed Republican majority or a relatively narrow Democratic majority. And I think the big thing, really looking at next year is if there is a switch in party control, what happens with the venerated filibuster, depending on which side of the majority you're on. The filibuster is either a wonderful thing or not so good thing. And is there an attempt to do that early on? And that could have, if there's an attempt to do away with the filibuster, it could have pretty significant implications for what is possible on the legislative side and how quickly things could move. So I think Vijay and Helen, we're going to kind of talk about some of the legislative, but we're happy to answer any questions on that afterwards as well.
Yes, I think next we'll go to Vijay. Thanks a lot, guys, on the political stuff. Vijay, we'll talk about some commercial issues. What are you seeing happening?
Yeah, thank you, Helen. Helen will talk a little bit about rental assistance after I go. But yeah, NAR has, as you know, has spent a considerable amount of time in the creation, improvement, extension of the Paycheck Protection Program known as the PPP. As you all know, we were very instrumental in getting the independent contractor provision into law, which allows not only realtors, but many of your small business clients access to the lending program, among other provisions. Unfortunately, this program expired this summer. And as Colin and Joe mentioned, it's been tied up in a very messy fight over the next COVID relief package. As Colin and Joe mentioned today, Senate Majority Leader McConnell has indicated that he will have a vote next week on a PPP extension bill. But as they mentioned, it's a purely political bill. And from all the discussions that I've had with Senate Democrats, it will not garner any Democratic support. While the COVID relief package has been very difficult and challenging to pass, largely because of the overall costs, we've been working on other programs specifically to find ways to simplify the loan forgiveness process for PPP loans. As some of you have noticed last week, the Treasury and SBA came out with a new streamlined forgiveness form for loans under $50,000. So it's about a 1.5-page form that borrowers would need to fill out and submit to their lenders. Borrowers basically would have to verify their payroll costs, the number of employees, their rent, mortgage, and utility payments for their covered period. This new forgiveness form is much simpler for eligible borrowers, and it would reduce the processing time for lenders. More importantly, the borrowers that use this form are exempt from the original PPP requirements that employee numbers remain the same during their covered period as before the pandemic started, along with the requirement that employee wages are not to be reduced. So that's a huge win for us. I know I'm very limited on time, but switching topics slightly, there are a number of tax provisions that are set to expire at the end of the year. These include mortgage debt forgiveness, the deductibility of mortgage insurance premiums, and the 179D commercial energy efficiency tax credit. Currently, there really isn't any opposition to these provisions, but given the legislative calendar that Colin and Joe described, Congress is likely going to focus on the Supreme Court nomination, reauthorization of the National Defense Authorization Act, and another continuing resolution to fund the government through next year. So this will likely push tax extenders to the congressional agenda, most likely after the next Congress is sworn in. So with that said, I'll turn it back over to Helen.
All right, thanks. Yes, we want to touch on the rental assistance and the eviction moratorium issue that I know you all have been very involved with. I know you've reached out to your congressional delegation, or your association has, and we appreciate that. This has been sort of like a slow burn type of issue. You know, when the programs and legislation started out back in March, and throughout the summer, there was not, I don't think, a recognition in Congress of the unique impact that landlords might have. Of course, an eviction moratorium would happen, but there wasn't an understanding that not every landlord can participate in Paycheck Protection Program. because rent that is collected is considered passive income, you didn't automatically, that meant you didn't qualify for some of these other programs. Plus, as people were having additional unemployment assistance, that was supposed to hopefully help people pay their bills. But there's been this slow understanding over the summer that no, if we're going to continue to have these eviction moratoriums, particularly the latest executive order that extended it far beyond where Congress had been, is causing problems and is going to cause real problems when everyone's bills are due at the end of this eviction moratorium. So we have been working with a coalition over the summer. We've had multiple meetings. We've done some advertising towards members of Congress on the Hill. NAR asked all of the FPCs to contact their members of Congress, and thank you all. I think Louisiana particularly went above and beyond and sent a letter to their delegation and while that was going on, so we appreciate that. But I think we had about 430 members of Congress get a direct phone call or email from a realtor saying, hey, there's a problem here and you've got to address it. The good news is that everyone agrees. Everyone gets the connection that if you're going to have an eviction moratorium, you've got to figure out a way to make people whole on the other side, because the lights still have to be on, the water still has to run in these places that people are, let alone all the problems with existing eviction processes that were going on. So we're not getting pushback on the reason for doing something here. Something on rental assistance has been included in just about every negotiation that's gone on. It wasn't in every package in the beginning, but since then it's been there. Secretary Mnuchin sent a letter up to Congress yesterday or today, and in one paragraph he lists about 5 things. Rental assistance is listed in there, so we're good on the why. The issue is the how, and just as Joe and Vijay and Colin all mentioned, that the challenge is really how do we get something through? When does Congress do a bill? How does that happen? We are pursuing sort of another idea, and we had a group of realtors meet with White House officials to see, and that included, I know Matt Ritchie from Louisiana was part of that group, to talk about, is there a way to take some of the existing programs that are out there and have the administration reprogram funds, or look at those definitions to see if there's a better availability to get the money, or use it so you get the money back to the states so the states can run these programs. We're still pursuing that. There seemed to be some opening on that, but we're just not sure, again, when it's going to get done. But thanks for all the assistance, for those of you that have helped us with this along the way, and for giving us your information on it. We are also working on with a larger group, potential lawsuit on whether the eviction moratorium is actually valid. That's a little more down the road, more to come on that. We're just seeing, again, trying to cover all bases, all options to see what we can figure out. So hopefully if one of these bills moves forward, we will be in good shape. It's just a matter of when. So that's what I have. I think that's what anybody, Joe, Colin, Vijay, anything additional to add right now, or should we open it up for questions if we have time?
Yeah, I think we're open for questions as time allows.
Okay. Let's see, I'm not sure how we can.
Okay, we just have a few minutes, and I want to thank Joe, Helen, Vijay, Colin, thank you, appreciate it. Some great insight on both sides of the aisle and what's happening in Washington right now. I have one key question, which is very important to the real estate industry. What's the current thinking regarding capital gains and 1031 exchanges? How do you see that playing out, depending on who wins presidency? It really doesn't matter, but just what's the current thinking on both of those right now?
Who wants to take it?
Well, I'll take a stab. On the House side, I know that a lot of the campaigns are getting a lot of coverage for their respective tax plans, whether 1031 is going to be on the chopping block or not. I can tell you, and having a lot of conversations with Chairman Richie Neal, who fortunately for all of us won re-election against a sort of a Justice Democrat in the primary. He understands the value of 1031s. And I don't think that anything is going to be done in terms of tax reform, at least on the House side, in the next Congress that isn't comprehensive and isn't based on sort of the impact of COVID, the impact of the pandemic. That's sort of where they're going to start looking at policies in terms of changing, because they understand that these tax changes can be very expensive, and they understand that they should not be done in a vacuum, but there should be some logic and some reasoning behind it. And COVID is still going to be a factor for us for a while. And I think that in talking with not only Chairman Neal, but folks like Pascrell from New Jersey, we have a lot of supporters of 1031 on Ways and Means, and they understand that this is not a tax giveaway, it's tax deferment. They're not after those types of programs. They're here to build the economy, they're here to create jobs. And so they're going to be looking at this through the lens of how do we sort of give tax relief, if anything, to the small businesses that have been the most impacted. What's the best way to do that without upsetting the apple cart too much?
I have to say, go ahead, Colin.
Okay.
I mean, this was one of the reasons I highlighted
Colin,
the issue with the legislative filibuster earlier. Is it'll impact timing, right? Like if there's a change in Congress and an administration wanted to push tax legislation. Again, I'll defer to Joe on this stuff because, you know, under the Constitution, all the tax legislation has to originate in the House, which is good. But yeah, no, I mean, it would affect Senate timing, right? You would, if there were changes to the legislative side of the filibuster, one party would be able to proceed without currently you got to have 60 votes to get on a bill. That would, you know, you'd be a bare majority of 51. So it's something to keep in mind as you're, you know, kind of listening to how things work out on election night. That's one of the things that could be affected. I mean, the other side is, you know, there are other procedures to get around that threshold as well. But you know, I think it's something that you'll hear more talk about reconciliation and the filibuster in the new year if things go one way.
Okay. Joe, Helen, Vijay, Colin, thank you. We appreciate your commentary. We will now take a 5-minute break and show a couple videos, and then we will do our closing with Guy Williams. Thank you.
Thanks for having us.
Thank
you.
Imagine a New Orleans that is growing, the economic heartbeat of the Gulf region. The New Orleans Business Alliance was created 9 years ago to make that future a reality. Since 2010, the city of New Orleans has been synonymous with success. Over these 9 years, the Business Alliance has helped to build a new economic landscape.
There are really two things that provide the framework for successful economic development. The first, business attraction and retention. You have to always retain and see your existing businesses grow. And then you also have to be very competitive for attracting new capital and new investment.
I moved back to New Orleans from Arkansas.
I was living in New York City.
I moved back from San Jose, California. Once I found out that Accruent would be opening up a new office in New Orleans, I decided to come home and return back to my family.
There are a lot more job opportunities just to even browse and apply to. There's just this new kind of economy on the rise. It feels complete.
The second is small business growth, because in a city that's majority person of color and majority women, you've got to make sure that you get all your players on the field.
New Orleans Business Alliance, they help you get a seat at the table. So it puts everybody in one place so you can meet and create relationships that way. Growth of my company through advocacy has been definitely substantial. We're in 15 different states now. We're definitely growing by leaps and bounds.
This city will achieve enhanced economic security. We get there by making sure that there are jobs that will provide life-sustaining wages for folks. We get there by making sure that there are tools that help our small businesses take that next level in the growth. That's economic development that puts people at the center.
Imagine how economic equity would change New Orleans. Imagine a New Orleans where culture, equity, and prosperity are what we create, protect, build, and grow.
New Orleans Business Alliance, culture, equity, prosperity.
Gulf Coast Bank and Trust is giving our customers the power to bank anywhere, anytime, and we're right there with you 24/7. Our mobile banking app is a smart way to manage your money and time. Gulf Coast Bank and Trust, the bank that cares about you.
Okay, we're moving or sliding into our last presentation. We will do a poll question at the beginning of the presentation and the one at the end. The one at the end is important because that's the closeout poll question, so you definitely want to answer the question on that. Our next speaker is Guy Williams, who is President and CEO of Gulf Coast Bank, and his topic is the future of New Orleans, the evolution of the new economy. Guy?
All right, good afternoon, folks. I want to talk about how we got here and what's love got to do with it. If you think about where we are, in March we had a global pandemic, and all of a sudden, from a super economy with everything going well, we had total panic. And in our country shut down, other countries shut down, the borders shut down, and there was genuine fear that we would have a global depression. And when you have that sort of fear, you have to have a quick response. And what happened is the Federal Reserve stepped in because they're the ones who can step in the fastest. They're the ones who have the liquidity. And what the Fed did is they threw everything at the problem. They threw $3.6 trillion of liquidity at the problem. And we hear those trillion numbers bandied around very casually. But let me give you a little perspective on how serious the Federal Reserve's response was. With $3.6 trillion, you can buy all of the auto companies in the world, all of the 4 big banks, all of the media companies. Think about this. We're going through a very contested presidential election. If you owned NBC, ABC, CBS, Fox, MSNBC, New York Times, Wall Street Journal, you could tell your story to everybody because you would own all of the media companies. You'd have enough money left over to buy all the airlines. So the biggest banks, the auto companies, the media companies, and the airlines. That's $3.6 trillion. That's how much money the Fed threw at the problem. And to give you one other point of comparison, we talk about 2 trillion's not enough, 1.8 is too little. In America, at the end of the year, all individuals and all corporations together pay just a little over 2 trillion in taxes. So all of our tax burden is $2 trillion. Some may wonder, well, if we're talking about a 2 trillion tax, why don't you just waive all of my taxes for a year? If you want to personalize it, for a family of 4, it'd be the same thing as getting a $20,000 check. Stimulate the economy, stimulate my economy. But the Federal Reserve threw everything they could at it. They wanted to prevent a global depression, and they did. They succeeded. We have to give the Fed credit. It was a very difficult time. They did what they needed to do, and they prevented a global depression. But these actions are not without consequence. The Fed also said, we're going to relook at inflation. And this is the most important thing for us going forward, particularly those of us in the real estate business. Because what the Fed said was, inflation is a market basket of goods. And if you look at that market basket of goods, it's a typical New Orleans basket, some healthy food and some healthy wine to go with it. Except food isn't in the market basket for inflation. Neither is energy. And people sometimes say, well, inflation's based upon stuff you don't buy. It's not really true. Over time, inflation does accurately measure what you do buy, but it's a market basket of goods. And what the Fed said is, in the future, our target is 2%, but we're not going to target exactly 2%. In fact, we're not even going to target just a little over 2%. What we're going to target is average over time. Now, for those of you who are a little older, you may recognize Willie Shoemaker, famous jockey, 4 foot 10 inches tall, and Wilt Chamberlain, 7 feet and 1 inch tall. These guys were actually friends. Each one bought a chair in his house so that the other could sit comfortably. But right now, we're in Willie Shoemaker inflation land. It's well below 1%. And what the Fed has said is, we want inflation to average 2 over time. And I don't think many people understood or heard this clearly, because what that means is, if we're going to have a 2% over time, we got Willie Shoemaker for a while, we also can have Wilt Chamberlain for a while. Now, some of you older realtors and older bankers remember high inflation, 12 and 14% mortgages. What the Fed is saying is, rates could go way up. Inflation could go way up because we're looking at average. This isn't imaginary. This isn't made up. This is what they've told us. This is their intention. They have said we want inflation over time to average 2%. So $3.6 trillion was thrown at the problem, a lot of money, and there probably will be another stimulus after this. And they also said we're going to work on average inflation. So when you think about that, all right, and those of you who are watching are thinking, don't quit your day job, guy, and second, keep him away from the karaoke stage. But Tina Turner's here for a reason. She says, what's love got to do with it? In the current market, we responded to a global crisis that could have resulted in a Great Depression. Federal Reserve threw the kitchen sink at it, $3.6 trillion, a lot of money. Federal Reserve also said, we're going to use forward guidance and we're going to make sure that inflation can come above 2, and not just come above 2, but stay above 2 for a while. So, what's love got to do with it? It means that you don't have options. When the Federal Reserve put their stimulus into the market, the way they did it is they bought all of the bonds and treasuries that were out there at higher yields. Well, when the Treasury buys all of the higher yield bonds, there are no bonds left for anyone else to purchase. They bought it all and they left nothing for anyone else. When the Treasury and the Congress put money into banks and loan demand was weak, suddenly banks didn't need to pay and didn't have a way to pay higher interest because there was no loan demand. If customers don't want to borrow money and banks have to buy securities that are yielding less than 1%, they can't pay more than 1% in yield on CDs. So you have consumers looking for yield, you have people looking for opportunities, but there is nothing out there. So when you think of Tina Turner, think of that. There is no alternative. And when your customers ask you, why is the stock market doing this? Stock market hit another record yesterday. It is going up at a ridiculous level. The way you look at the stock market is what's called a price-earnings ratio. And what that does is it looks at, okay, what is the earnings for a stock? If it's $1 and you pay $15, that's a 15 price-earnings ratio. And historically, that's the long-term average. Last year, the price-earnings ratio was about 20. Which is a little higher than average, so you think that's good. But last year we had no unemployment, the future was bright, no one had heard of COVID-19, and only 3 people in America knew where Wuhan, China was. But the stock market was trading in the 20s. Now it's trading above 30. We're in the middle of a contentious election. We have lots of things going on. We don't know how long the recovery will last and how long it'll take to get back to normal. But because there is no alternative, people are flooding the stock market with cash. So when people say, why is this happening? It's happening because there is no alternative. It's not that people love the stock market. That's why I say, what's love got to do with it? People don't love the market at these prices, but they don't have anywhere else to put the money. If you're running a mutual fund and you go to the bond market and they say, we can give you less than 0.25% interest on a bond, suddenly stocks look pretty good. And that's why we see stocks trading at 30 price earnings multiples. It's not that they love stocks, it's that there are no alternatives. Now, what does that mean for us in the real estate business? Now, I know my sharp-eyed friends are all going to look and see whose sign did he pick. This is deliberately an out-of-market sign. I have way too many friends in this business to pick a sign that have one person's name and not another on it. But you all know, and we know, if you list it, you can sell it. It is an amazing time. We have had the best 4 months in the mortgage business we have ever had in the history of the bank, and we've been a big mortgage lender for a long time. It is a phenomenal time. Our builders are doing It's just unbelievable business. They want us to finance a lot more spec houses, and we're financing some more. We're not financing quite as many as they'd like, because builders will build like crazy. We won't have a bit of grass left if we give them all the money they wanted. But what we're seeing is our builders are busy. Our home improvement contractors can't take a new job this year. Our pool contractors are talking about next spring, and everything is selling. Gets back to, what are the alternatives? There are no alternatives. Real estate is actually one of the better alternatives. This is one of the times where we in good conscience in this industry can tell people, folks, real estate is a good, stable investment. If inflation comes back, which it might, and the Fed has said, if it comes back, we're going to let it run for a while, real estate is a great hedge for that. So in good conscience, we can tell people this is a great time to buy real estate. My late friend Larry Boudreau from Pelican used to always say, this is a great time to buy a house. If Larry were alive today, I'd say, Larry, you're absolutely right. This is a great time to buy a house because it is an inflation hedge and rates have never been lower. It is amazing. It doesn't mean that you have to love it, but it is a time when you should buy real estate. We could recommend real estate with a good conscience and a good sense of fairness for our customers. It's also a great time to buy investment properties. So if you can find an investment property with a reasonable yield, this is a time when it'll sell, and this is a time when there's a high demand because stock market's overpriced, bond market gives you zero. Real estate is a reasonable alternative, and it's one of the few that's left over. Now, of course, we know most of our customers buy based on price. So we're beginning to see that price appreciation, and this is normal at this point in the cycle, but it's still not excessive. And we've been pleasantly surprised that prices have not gone up as fast as they have in prior periods with super low interest rates. So we're seeing some increase in pricing, but not an excessive increase. So it is a good opportunity to encourage people, A, to build, and B, to buy. Now, some people say, what is going to happen and how long is this going to last? And that really is a legitimate question. If you have children or grandchildren, you may be familiar with Winnie the Pooh. This is Eeyore, the gray donkey, our burro, as I was told correctly. The gray burro is the most pessimistic character in the Winnie the Pooh series. And when is help going to arrive? Days, weeks, months, who knows? What the Federal Reserve has told us is rates are going to remain low for a long time. Days, weeks, months, years, who knows? Now, why does that matter? It matters because right now we're refining everybody that can refi. We're doing purchases for people that want purchases, but the folks who are left out are the ones with no down payment and bad credit scores. This is the time to get those names, get them signed up, get them into credit rehab programs because time is on our side. We can work with those folks, and typically in 6 months to a year, you can get the credit scores up to a reasonable range. Don't throw those people away. There will be an opportunity next year to put them into houses. So as we talk to people, we know the credit scores have been raised, we know the standards are tight, but the people that don't meet them today can meet them in the future. And we have an obligation and an opportunity to make sure that this boom lasts for a while. And one way to do it is to restock with people that don't qualify right now. So the Federal Reserve has told us this is going to last for a while. You've got some room to run. You can do it. So what we're doing is keeping track of the people that we have to turn down today. We're explaining why we have to turn them down, and we're telling them what they need to do so that they won't be turned down next year. So it's an important time and it's an important opportunity. Not everybody's doing it, but it's a way for you to build business for next year when this boom is over. So, what do people want? More. All of our customers are looking for the same thing. They want more yield. How can you find it? It's really difficult. People are going into the stock market, not because they love it, but because it's a place where they think they can get more yield. People are buying investment real estate at pretty outrageous cap rates because it does look like it gives them more yield. I would rather be in investment real estate at an outrageous cap rate than the stock market at a 30+ PE, because if inflation comes back, that real estate can work for you. Stock market could be a bit of a problem. The people who really are left behind, and this is truly unfortunate, are retirees trying to live on fixed income. Wall Street Journal had a story today, special program for baby boomers on extra income, and I eagerly pulled it out because I thought, this is great. They'll give me some new tips I can share with the group. The only tip they had was work longer. It's like, well, great, that's a lot, that's really helpful. Work longer, and just figure you're gonna have to spend your retirement money and take money out of bonds. Well, that's not particularly helpful. But what they did say is there just aren't good options right now for high yield. There aren't safe options for high yield. As much as you might want it, it's just not gonna happen. So we need to be honest with people and say, look, Federal Reserve is committed to low rates for a while. That means the stock market's gonna be high. That means real estate has a good chance of appreciation. But it means you're not gonna make much on fixed income investments. So, as we think about it, what's love got to do with it? We don't love the stock market. We do sort of love the real estate market, and people don't have options anymore. So what we're seeing is Federal Reserve has told us interest rates are going to stay lower for longer. Take advantage of this and keep your customers who don't qualify today, make them tomorrow's business. You can build your future with turndowns today. Demand is going to be strong. Demand for real estate is going to remain strong, and demand for good investments is going to remain strong. But we need to remind people there are no risk-free high-yield investments. There's a company that advertises on business radio, we have a 10% REIT return guaranteed by high-yield properties. It's just not true. There are no risk-free high-yield investments. But there are some good investments in real estate, and there's some good opportunities for us in this business. We know it's going to last a while. We know people don't love the low interest rate environment, but for us in the real estate business, rates have never been lower. So, good opportunity, good chance to build tomorrow's business today, good opportunity to put people into houses. And one last thing that we recommend is when folks refi, we encourage them to shorten the term, because there is some comfort and some safety in having your house paid for. If you can go from a 30 to a 25, do it, 25 to 15. There's a lot to be said for paying your house off and owning it free and clear. It just takes a lot of worry off the table, because none of us know how this super liquidity push by the Fed ends. We have never before put this much debt on the national balance sheet. So we know that it pushes rates low. We know that it pushes stock prices up. We don't know how the story ends, but we do know if you buy a house and pay for it, you got a place to live and life is good. So, what's love got to do with it? Not too much, but there are no other alternatives. So you need me out?
No, your question right here. Go for it. Questions? Okay, audience, please be reminded you can still answer questions. Guy had a couple of questions for you. Do you think we can sustain the current level of real estate activity?
We can for a while, and we keep thinking that it won't be sustainable, but our pipeline's bigger than it's ever been. So, at least for a while.
So do you think it's a function of interest rates, or what? What's driving this level of activity?
Well, it gets back to what I was saying. There are no alternatives. If you have money, you can look at a stock market that is very, very overpriced. You can look at bonds, which give you nothing, or you can look at real estate, which has a combination of a low rate and some good upside.
We had a question from the audience, which was interesting. What do you think will be the impetus for investors to fall out of love with the stock market?
That's a good question. I think your political panel earlier didn't address the issue of capital gains, but if there's a sweep, the proposal in the party package is to treat capital gains as ordinary income. So if there's a sweep in November, I would expect people to sell stocks this year when capital gains are still treated as capital gains, as opposed to next year when they'll be treated as ordinary income. So I think people could fall out of love with the stock market in December.
Okay. We've talked a lot about the residential lending market. How do you think how does the commercial lending market compare with the residential lending? And then what do you see happening in the commercial market for 2021?
Commercial is really a tale of two markets. Some properties are in high demand and others people are scared to death. So high-end hotels, when do conventions come back? It's very hard to project forward when you have 50% or less occupancy. So it's hard to justify room rates and the cost per room in the big hotels. Office buildings, how many people want to go back to the office? You know, we find at work half the people like staying home and don't want to go back to the office. Well, if we cut our office demand by 50%, boy, that really affects the market. I don't think it'll be that high, but even 20 is a big deal at the margin.
We had a question from the audience. How do you see, given the current market conditions, particularly in commercial, because it was a commercial-related question, do you see changing loan-to-value ratios as either a function of risk or as a function of the marketplace?
Well, I think on the lending side, the loan-to-value ratios will probably push down a little bit because banks are getting a little nervous, but then the countervailing pressure is there's very little loan demand, so then you have competing banks that are raising the loan-to-value ratio and giving you a smaller down payment. So those two are probably going to balance each other out, and if anything, you might be able to borrow a little more going forward because there's such low loan demand.
Another question from the audience. Do you project or see a bump in the number of foreclosures, particularly for residential, in the foreseeable future, particularly as forbearance seems to be timing out?
I think you may see more evictions than foreclosures. Most people still have the ability to make their monthly payments, and they'll look for a way to do that. Folks that are in a house really don't want to lose their house. So I'm not looking at this is not the 2008 crisis. And unemployment's coming back pretty well. There are a lot of companies trying to hire right now, so I'm optimistic that the foreclosure rate will not be that high.
A big issue for our market, really everywhere in the U.S., is evictions. And when that eviction moratorium burns off, will you have any trouble lending on multifamily of any size in the marketplace today?
Not really. Part of the challenge is the eviction story is a case of two sets of folks. There are a group of people that got unemployment and just chose not to pay the rent. When evictions reoccur, I'll just move. And the sort of malicious non-rent payers. They had the ability to pay, but they chose not to. But the other group are the ones that lost their jobs, were in the gig economy, didn't have income, and they're really up against it. So you have great sympathy for the folks that lost their jobs and didn't have the ability to pay. And then you have less sympathy or no sympathy for the people who had money and just chose not to. There's a pressure between those two groups. The eviction moratorium at this moment ends in December. We'll see what happens next year. There is real talk of another stimulus package, and the numbers are so big. If Congress would simply write checks to people, I think that would be better. I mean, think about, Paul, the stimulus that we've done so far. $2 trillion of stimulus would be $20,000 for a family of four. We've done 3.6 in stimulus. So that would be over $30,000 to you as a family. Maybe it's better just send the money to the people than to, filter it through Washington. You remember after Katrina, they appropriated billions, but 50% of it never left DC. It kept circulating between contractors before it finally got to us with a big discount. I'd rather not see it circulate in DC and just go straight to people.
FHA and VA loans are a big factor in the marketplace. Do you see any changes in the requirements or criteria for that?
Well, one of the ironic things is when this all started, the federal agencies raised their standards and made it more difficult to buy. So, on the one hand, we're having stimulus. On the other hand, we're having the agencies make it more difficult to buy properties. So I think that's going to depend on who heads the agencies next year.
Okay. Last question, the easiest, of course. What do you see happening in New Orleans for 2012? Rub your crystal ball, and what does it tell you?
Well, since you asked about 2012, that's great.
I'm sorry,
No, that's easy to
2021.
answer that one, Paul. Come on.
My bad. 2021.
Oh, future question.
Yeah, sorry.
Unfortunately, I don't think we have Mardi Gras, which is really disappointing. I think that conventions come back in the summer, and I think we see a slow recovery. And I wish it were quicker. I wish I weren't saying that, but that's my best guess.
Wow, okay. Well, you heard it here first from Guy Williams, CEO and President of Gulf Coast Bank. That pretty much wraps up our program. Would you put up the poll question? Again, on behalf of our title sponsors, Gulf Coast Bank and the boards of NOMAR, LACDB, CID, and LR, we thank you for participating today. We hope that you found the program informative and insightful, and will sharpen your focus on what's happening in your market today and for 2021. Hopefully you'll join us tomorrow for another program that will include discussions on the economy, banking, demographics, and the challenge of China. Guy's going to be talking about China. And if you're participating tomorrow, you will receive an e-link immediately after this program. And having said that, we want to thank you and have a great day. Poll question is up.
If you want CE, answer the poll.
Yes, I've been instructed. If you want CE, please answer the poll question. So that would conclude our program today. Thank you for participating, and we hope to see you virtually tomorrow. Thank you.
All right, very good.